In London with Tom McKenzie.
And here are your top stories. Global equities rally ahead of today's US jobs report amid speculation the Fed will hold off hiking rates this month. Oil gains before this weekend's OPEC Plus meeting. The debt ceiling bill clears the Senate, removing the risk of a US default. The measure now goes to President Biden for his signature. Plus, Goldman Sachs warns trading revenue is down more than 25% as economic headwinds build, while Bank of America sees a flattish quarter.
Tom, if you look at the futures, we're seeing a little bit of support, gaining some 0.4% higher, certainly for the FTSE futures. A lot of the folks, of course, on tech in Asia that saw a bit of a rally, and still there's a lot of hopes that the Fed pauses interest rate hikes.
Yeah, and the two of those, of course, are linked. The Fed tying into what's happening. That tech rally in Hong Kong is pronounced, and we'll have a look at that index just shortly. But, of course, a number of factors then keeping the catalyst around the optimism, around the upside going. Hearing, of course, from fully Fed President Harker saying not only should we potentially consider skipping in June, but possibly in future months as well. It's really starting to build the narrative that the Fed is in a position where it's comfortable to pause in June, even as we wait the non-farm payroll data out later today, with a tick down that is expected from plus 200,000 to around 195,000. That is the expectation around non-farms out later today. And then, of course, the debt ceiling deal, that is now done. It just needs to be inked by the president. Gains then across these European equities, building on the upside that we saw yesterday. Don't forget, Wall Street closed in positive territory as well. The CAC Cajon adding 0.6%. The Spanish IBEX in similar territory, adding 54 points. And here in the UK, the FTSE 100 gaining 0.5%. Let's flip it over then and just reflect on what's been happening in the space in Asia. You have the likes of the Kospi over in Korea getting close to bull market territory. Meanwhile, of course, those Chinese stocks listed in Hong Kong, they were sniffing the edges of a bear market if they hadn't already got there. That's being pulled back now on the optimism today. Again, really linking into the expectation that maybe the Fed is going to pause on hikes, but also some dip buying as well. The valuation story has been something that a number of our guests have expressed around those Chinese stocks. And the HS Tech Index currently up, look at that, a little over 5%. The big tech names like the likes of Meituan and Alibaba doing very well this morning. Futures in the US looking to build on the upside that we posted yesterday. The NASDAQ was the clear out performer, but the S&P also logged gains of a little under 1% by the end of the session. Looking to build on that with gains of 0.2% on the S&P E-minis. And here's the Turkish story then. Erdogan fulfilling at least that pledge around the edges to bring back a more centrist policy position when it comes to economics, finance, of course. So the new finance minister coming in, Mr. Simsek, and there's optimism now being reflected in Turkish assets. Not so much in the Turkish lira, but certainly in terms of the banking stocks. Here's the lira move then. You're actually seeing dollar up 0.3%. So it's not really being expressed in the currency, but in terms of stocks, the gains are pronounced, particularly around the banking space. Gains of a little under 6% then on the announcement that Simsek will be the finance ministry. Again, someone that the markets are comfortable with. And here's the broader benchmark, of course, in Turkey, adding gains of 2.6%. We'll see, of course, if Erdogan builds out that position in terms of the cabinet to kind of reassure those markets after all of that unconventional policy. Francine.
Let's dig a little deeper into the sector as a whole. So we have 20 groups making up the stock 619 are on the up. So I'm just seeing one down, and it's only down some 0.3%. That's healthcare. Then I have basic resources. I have real estate. I have retail on the up, gaining some, well, between 2 and 1%, Tom.
Okay, now the latest US data has seen the market lean further towards a Fed pause, as I mentioned, in June, with equities rallying yesterday, of course. and two-year yields falling. Bloomberg opinion columnist and former New York Fed President Bill Dudley says the Fed needs to push US interest rates even higher.
Well, they're going to take a pause because they believe that there are long and variable legs in monetary policy, and so they want to see the effects of prior actions. But they've characterized it as a skip because they think that they'll probably have to do a little bit more. And we'll probably see that in the summary of economic projections. We'll probably see a couple, one or two additional rate hikes penciled in for 2023.
Okay, Bill Dudley there, of course. For more, let's bring in Bloomberg's markets reporter, Valerie Teitel. Valerie, so another big data point today with the payroll report. It's expected to come in softer than the previous month, the month of April, of course. We're looking to May later today. What are the numbers that are going to be central to the decision-making, at least the market moves, as we start to work out whether June is indeed locked in as a pause?
Yeah, it's funny, Tom, so much for a data-dependent Fed. They seem to have penciled in this pause in June, even before the labor market report today and CPI in a few weeks' time. But yes, you're correct. The payroll number, it is expected to moderate slightly from last month's print to 195K. Note the whisper number is slightly higher than that. Also, the unemployment rate is expected to tick up from 3.4% to 3.5%. Remember that the Fed's year-end unemployment forecast is actually 4.5%. So we need to see some substantial weakness in the labor market in the coming months in order to hit that 4.5% if we only get to 3.5% today. We are expected to see some moderation in the month-on-month average hourly earnings from 0.5 to 0.3. Remember last month, this was a substantial beat in the wage numbers and these average hourly earnings numbers, both month-on-month and year-on-year, hoping to see some moderation there today. But if this payroll number comes in above 195K, Tom, that brings the consensus beats, the streak of beats that the NFP has had, to 14 months. We've hit 13 months so far, so if that whisper number does come true, it'll make it 14 months. You can just see in this chart here how that compares to the biggest streak of beats we've ever gotten before was 5, and now we're at 13. Just substantial how much the labor market continues to surprise.
Yeah, it's amazing. I think I saw 5 banknotes, Valerie, of people saying, look, this jobs report is just less important. The other story was really the fact that demand for the Fed's repo reverse facility dropped by the most in 2 months. What does that mean in terms of, some of the cash buffers that Treasury could have?
Yeah, exactly, Francine. Now that this debt ceiling debate is behind us, the market is looking forward and how the Treasury plans on rebuilding its cash buffer. Now, the worry is if it does this too quickly, it could sap liquidity from the market, perhaps proposing a big headwind for tail markets, for risk assets, perhaps denting this equity market rally we've seen of late. The market is really going to be watching the Treasury auction sizes. Now, yesterday, the Treasury actually failed to give auction sizes to their T-bills that they're supposed to auction next week, thinking that there could be even more canceled auctions, which could lead to bigger and more substantial auctions in 2 weeks' time, which could really pose some worries over an oncoming liquidity crunch if the Treasury looks to rebuild this cash buffer quite quickly.
Valerie, thanks so much. Valerie Teitel here in London with us. Now let's get straight to the Bloomberg Business Flash. Here's Alex Morgan. Hi, Alex.
Hi, Francine. Good morning. Well, we start with Goldman Sachs, who are warning of a sharp slowdown in its investment bank as compared to the bumper gains a year ago. Its president, John Waldron, says the trading business is trending down more than 25% this quarter. Goldman is working on what would be its third round of job cuts in under a year. Broadcom says artificial intelligence-related sales will double this year, but that won't be enough to offset a broader post-pandemic slowdown. The CEO, Hock Tan, says AI-focused chip revenue may soon make up 25% of the company's sales. While total revenue is expected to rise less than 5% this quarter, as Broadcom's slowest growth in years. And the CEO of Palantir says new AI developments are so powerful he isn't sure if they should even be offered to some of the customers. Speaking exclusively to Bloomberg, Alex Karp says he's wary about providing the tools to local law enforcement agencies for purposes such as surveillance.
Usually we have to go out and find people. Now we have customers, especially in the U.S., just calling us every day.
Well, you said the demand is huge. Can you quantify it in some way?
Usually, we've had a number of inbound calls in a year that we usually have in a year in like a month. We're offering things that are so powerful that in reality, I'm not sure we should even sell this to some of our clients.
Well, that is Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Francine.
Thank you so much.
All right, Alex, picking up here. Thank you very much indeed. We'll round up with some of the top stories with a check there on AI. Really interesting response there from the head of Palantir. Now, let's get to some of the individual corporate stories. Individual stocks on the move. This, and we're going to focus in on the UK because it's a pharmaceutical story. Dechra, right in the middle of your screen there. Dechra Pharmaceuticals. There is an offer coming through from EQT to buy this with a 44% premium. It is the biggest take-private deal in the UK. A little bit more colour on this. They have agreed then to be taken over by EQT, by one of EQT's businesses called Freya Bidco. And again, it's a 44% premium to the closing price, and it values the company at around £4 billion. So not surprisingly, you're seeing a big uptick there in terms of that stock price, gaining 8% on the back of that news. When it comes to Spanish banks, this is an intriguing one. The CEO of Unicaja, that's on the right-hand side of the screen, gaining 0.5%. Stepping down, Manuel Menendez, and the board apparently seeking a new CEO immediately. There'd been some tension apparently within the bank because Menendez had been the CEO of another bank, a competitor bank that Unicaja had taken over. So changes at the top for one of those smaller Spanish lenders. Crédit Agricole, different space, larger player, of course, getting 0.6%. The first overseas bank this year to sell a samurai bond, raising 1.1 billion. These are securities that potentially could be written down in terms of, or in the context of a banking crisis. So again, it suggests that maybe some of those concerns around banks are starting to ebb again. They were able to go to the market, Crédit Agricole, and raise 1.1 billion. It's essentially tier 2 capital. So that is receiving a little bit of positive upside, 0.6%, maybe less about the capital raise, more about what's happening generally across these risk-on markets. Now, we touched on AI in the business news. Coming up, the market for AI avatars is forecast to ramp up rapidly. My very own digital avatar is going to tell us more. That is next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. So far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jake Powell thought he'd be looking at.
It really signals an employment market that's chugging along
Miles from where the chairman of the Fed wants to be.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
Tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May Jobs Report, today on Bloomberg Television and Radio.
Welcome back to the Open, everyone. 13 minutes into the European trading day. This is the picture across the board. Some gains, 0.4% higher. In fact, the CAC 40 is actually gaining 0.6%. Now, there's a belief in the markets that we're not going to see another interest rate hike from the Fed in June. Again, watch out, because a pause is not a done deal. And so that would leave stocks at risk of a reverse should a jobs data surprise to the upside. Of course, that jobs data a little bit later on. Oil inching higher, but still on track for a weekly decline. That's as OPEC and its allies prepare to meet in Vienna over the weekend. Now, the oil cartel will discuss output and the state of the sector against the backdrop of global economic uncertainty. Let's get more with Bloomberg's Manus Krani, who's heading to Austria as well. So, Manus, thank you for joining us. What are the actual biggest risks as we head into the meeting?
Tom, Francine, good to see you. I would say it's the triple C. There is a lack of consensus. There is a lack of cohesion. Yes, to the outside world, they'll walk in, we're all united, but there is a lack of cohesion in the OPEC plus. I emphasize the word plus because that involves Russia. We'll come to that in a moment. And there is a lack of China. That great, roaring, China recovery simply has not been delivered. Eurasia described the current status quo as the anti-Goldilocks position. I say to you, it's about the flow show. The Russians pledged to cut more. Alexander Novak, the deputy prime minister, sat down with me in Vienna 7 months ago and said they would cut. And the bottom line is they didn't deliver. Flow from Russia is 1.4 million barrels a day higher than at the end of last year. They've only begun to cut. Russia, Iran, and Venezuela. Iran production is at a 4-year high. This is a bruising situation of oversupply and a lack of consensus on a deficit into the second half of the year. Good morning. Is it technically? It is still good morning in Dubai.
Manus, does that lack of consensus then underpin or at least maybe derail that threat? We heard the Saudis talking to France saying, hey, short sellers, be warned on this. Does it kind of undercut their legs on that threat to speculators?
Just picture in your mind, oil was at $100, $90, $100 in the latter part of last year. There's been 3 moments of where the power of the ouch was brought to bear. The power of the ouch is this phrase from His Royal Highness Prince Abdulaziz bin Salman, which is a salutary warning to the short sellers in the market, who he and Haytham Al Gaith have blamed for the dysfunctional market, although that particular narrative runs a bit thin. So you had a 2 million barrel a day cut at $90. Down we went. April, we had a non-codified cut of 1.2 million barrels at $80. Down we went. And there is this consensus that Houston, excuse the pun, who are refilling their SP, or America, Houston, anybody who wants to listen, we have a problem. We have a problem in that we could be going into a material slowdown. There is a transition, war at risk. BlackRock were with me this morning, and these are the structural, evidential problems in play. So 2 blasts of the ouch, and down we go. And the speculators are, I would say, almost pushing and goading OPEC Plus into making a cut. But what we don't want is the Russians to run out the door. Of course, I won't be inside because I haven't been invited inside. I am waiting for that phone to go and the invitation to come. I'm sure, I'm confident in the next 24 hours I will be part of the conversation, but I will be standing outside harrying like hell.
That envelope has to land, surely, on the doormat of Manus Krani. How can you not have Manus Krani in the room?
The phone's over there.
On
the phone
OPEC
is over
Plus?
there.
Okay. The phone's going to ring, I'm sure of it, Manus, in the next couple of seconds. Brent currently up 1.2%. Manus Krani, excellent, thank you, as always. Of course, heading off to Vienna shortly to cover that really important OPEC Plus meeting as we look at Brent higher by 1.2% in the morning session, currently at $75 a barrel. And of course, what happens with Brent ties into the inflation picture, of course. You don't need to be told that, but it's a reminder as we bring in Lena Komaleva, G+ Economics Chief Economist. Lena, let's start with inflation picture then as we consider the next steps for the Fed. Are you getting the sense that they are comfortable to pause despite what happens with non-farm payrolls later today?
A very good morning, Tom, Francine, and Manas. That was a brilliant OPEC coverage. I really enjoyed that. Yes, inflation readings are coming down, but they're coming down much more slowly than they're sent over the last couple of years. And what's more, there's that conspicuous stickiness in underlying inflation, so beyond the headline energy base effects, which are clearly hiding firmer underlying consumer spending trends. Now, there has been some helpful talk from the Fed in recent days about skipping the June meeting, but there is no consensus whatsoever from my discussions with policy officials about what to do later in the year. And in particular, based on the Fed's own sort of neutral rate models that have just been updated since the pandemic. While the long-term neutral, the R star so-called, hasn't really changed that much, according to the Fed or the IMF for that matter. The short-term picture is not clear. I think at just about 5%, the Fed is only at the beginning of the comfort zone, but that is a very data-dependent comfort zone. And that means that today's non-farm payrolls report will be critically important on how that disconsensus at the Fed evolves.
Yeah. Lena, I mean, we understand that maybe the bar has been raised relative to prior, of course, jobs and to prior meetings of what the Fed does. Does it change your view on whether they cut or not at the end of the year, if they pause in June?
Well, I think the Fed is heading towards a very uncomfortable situation whereby falling headline inflation because of the energy base effects, and of course the OPEC meeting this weekend will be critical in how energy prices and therefore inflation expectations in financial markets evolve in the coming weeks. So that is critical to watch. But from what we know at the moment, falling headline inflation is set to push real interest rates sharply higher by the year end. So falling CPI versus even if the Fed were to hold a certain levels of Fed fund rate, and that will aggravate stress in credit markets and in the banking system, pushing that liquidity sort of headwind into corporates which will collapse credit demand. So that will stress highly levered parts of the economy. That would, in a normal cycle, put pressure on the Fed to start cutting interest rates, which is what the market is expecting. But at the same time, the stickiness that we have in core inflation readings is going to prevent the Fed, I believe, and other central banks from responding to those stresses via lower rates. Yeah. And this makes this macro risk cycle, fundamentally different from any other economic cycle that we've seen in the last 40 years. The market is not ready for that. I think that this is going to be probably the most difficult part of the tightening cycle for the Fed.
Lena, thank you so much. Lena Komilevo, G+ Economics, stays with us, of course, as traders are betting that the U.S. monthly jobs report will show enough moderation in the pace of hiring for warranting a June no interest rate hike. Stay with Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. There's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Bloomberg UK, your source hours for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back to the Open, everyone. 23 minutes into the European trading day. A lot of the focus, if not the only focus, of course, is on U.S. jobs and whether it'll blow everything out of the water and push the Fed towards an interest rate hike in June, which for the moment is not really being priced in. We're seeing stocks getting between 0.7 and 0.4%. Now, we're back with Lena Komileva of G+ Economics. Lena, thank you so much for staying with us. Now, we're talking about the Fed and what you're expecting for June and beyond. The ECB is interesting because we heard from the French central bank governor and saying, like, look, what they've done in terms of hikes is starting to feed through inflation. Is that correct?
I'm sorry, Francine, I didn't catch the last part. What they've done with rate hikes?
Is starting to filter through inflation, which is why we've seen inflation coming in below expectations in many European countries.
I think, absolutely. So, okay, so central banks can breathe a sigh of relief here because, of course, falling headlines, CPI rates, in the Eurozone, but also, of course, in the US and in the UK, are finally starting to converge sort of inflation towards the central bank's 2% target. But of course, we're nowhere near that. And what is also concerning is that underlying inflation is more than double the central bank's 2% target. So that is worrying. There are some tentative signs, and this is very much what has been behind the market's sort of more constructive tone this year. That inflation is past its peak, and therefore the central bank's rate cycle should also be reaching a peak. So that has brought some relief to markets in recent weeks. What we are seeing, however, is that consumers have been reluctant to adjust their spending to weaker disposable income growth in response to the cost of living crisis. And of course, Europe was very much hit by higher energy costs through the war in Ukraine. Now, that adjustment means, or the lack of a consumer spending adjustment to higher prices, has meant a stickiness in underlying inflation, which combined with the fact that we have had all that fiscal support for consumer budgets through energy support packages, transport support packages, means that it will be a very long time before core inflation reverts to a 3 to 4%, let alone towards the 2 handle on a CPI rate. So that's
Lena,
something that banks will have to watch.
Yeah, and you're mapping out maybe 12 to 18 months in terms of higher for longer for these central banks, but with the important caveat that something else doesn't break. What are you looking at in terms of the next tension point as the central banks continue, at least the ECB, to go higher on rates?
Yes, I mean, there's no question that a combination of rising rates and central banks draining reserves through quantitative tightening and banks experiencing more constrained deposit growth, as well as a higher cost of capital through the stresses we saw this year, the spillover of US regional banks, and tightening credit standards.
Okay.
All of this will constrain the flow of money and credit to markets in real economies.
We're running short of time, but we appreciate it always. Lena Komileva, G+ Economics Chief Economist, thank you. Coming up, more on these markets. Stay with us. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Global equities rally ahead of today's U.S. jobs report amid speculation that the Fed will hold off hiking rates this month. Oil gains before this weekend's OPEC Plus meeting. The debt ceiling bill clears the Senate, removing the risk of a U.S. default. The measure now goes to President Biden for his signature. Plus, Goldman Sachs warns trading revenue. It's down more than 25% as economic headwinds build, with Bank of America seeing a flattish quarter. So, Tom, what are you looking like, or what are you looking at in the markets?
Well, equity markets here in Europe are building on the gains that we saw yesterday. Of course, there was a positive handover, not just from Wall Street, but Asia as well. And Chinese tech stocks really rallying in Hong Kong, making up for at least some of the losses that we've seen coming through for that space. Again, on optimism that maybe the Fed is getting ready to pause. And of course, that debt ceiling deal clearing the hurdle, getting to the desk of the US president. Some profit dipping in terms of profit buying as well. Profit taking had been taking place in those Chinese stocks. Now they're looking pretty cheap. So a little bit of upside coming through there. Across this benchmark, you're seeing gains of 0.5%. The DAX is closing in on 16,000, adding 103 points. The FTSE 100 back above 7,500, gaining 0.5%. Again, the optimism and to what extent that is tied to the expectation that the Fed will pause in June. Non-farm payrolls, the number is 195,000. That's a survey from 253,000 back in April. But you could be setting yourself up for disappointment if it comes up significantly higher than that. But the voices from the Fed, at least in the last few days, have been seeing to kind of corral around the idea that June at least is paused. July remains an open question. Across these sectors, let's change it on. Every single sector bar, the last time I checked, 2, there we go, in the green this morning. Real estate leading the charge. Basic resources also up 1.7%. Just 2 sectors then, part of that off in terms of risk-off sentiment tilt that you normally get. Not performing well today, of course, because it's broadly a positive session. Utilities currently down, healthcare as well, off by 0.4%. Again, top of the list, real estate, basic resources. Energy is coming through. WTI and Brent are both bid. Manus Cranney talking about that lack of consensus amongst OPEC Plus, that meeting happening, of course, this weekend, Frank.
Now, ahead of the payrolls data later today, Tom, traders are betting on a Fed pause at its June meeting. This comes, of course, as a slew of FOMC members have also been signaling their preference for keeping rates steady at the next meeting. Let's bring Bloomberg's MLive Eddie van der Veld. Eddie, so good to speak to you. So with attention away from the debt ceiling debate, how important is today's jobs numbers if they've already guided through not hiking in June?
Yeah, look, we have seen significant guiding this week, particularly from Philip Jefferson, who's now been nominated as Fed chair. Before that, the market was pricing something like a 70% chance of a hike in June, and we've gone back down to something like 30%. So, you know, there's now significant weight behind the idea that they're going to pause. However, if we see a really hot jobs number once again, then you might start asking the question, well, why should they, right? The economy is holding up. There's no sign that inflation is really softening to the levels that the Fed would like to see. And I think, therefore, we're looking towards, you know, really a deep dive into these numbers before traders make up their minds for what they're going to do.
Okay, so June, to some extent, even despite what we've been hearing, it still remains something of a question mark, even as you heard, as you say, those really important, influential voices, the wingman, essentially, for Jerry Powell, saying that it could be time to pause in June. When it comes to July, though, Eddie, and where we go from there, what is there? Is it all about CPI? Is it about the wages and the jobs data? Again, leading up to non-farm payrolls this week, the job prints have been strong.
Yeah, you know what? I think, sure, CPI is important. If we see inflation coming down sharply, then that will give the Fed pause for thought. If it comes in hot, sure, that will really matter. But I think actually the Fed cares at this point a lot. The Fed thinks that inflation is quite sticky. They would like to hike, but they are worried about hiking too much and pushing the economy into a recession. And I think, therefore, the jobs print actually right now is more important than CPI. I think for over the last couple of years, CPI has been absolutely everything around which traders have been trading. But I think now we're going to start looking at a deep dive. We're going to start looking at wage inflation, and we're going to start looking at the participation rate. And we're going to start seeing if the participation rate picks up and jobs growth slows, then I think, you know, at the same time as we see wages continuing to rise, then I think that's going to be a really difficult situation for the Fed.
Eddie, a lot of the focus also on the Fed is, of course, some of the debt issuance. We saw, you know, some funky moves in terms of T-bills because of the debt ceiling. Are you expecting everything to normalize as we get into the summer months?
I think there was no bigger sigh of relief anywhere than at the Fed when there was finally a debt deal struck, because this is not a conundrum that they really wanted to deal with. Now they still have to deal with the fallout, and we are going to see what they do with issuance, and that obviously will have market implications across the board. But I do think the Fed is very relieved not to have to deal with a US default.
Yeah, indeed. Heading to the president's desk, it will be signed imminently. Bloomberg's MLive's Eddie van der Walt, of course, looking ahead to those non-farm payrolls out of the US, the forecast for 195,000, what it means, of course, in terms of the Fed's calculations. Talking of jobs, there is, of course, a risk that AI could take at least some of our jobs. The AI frenzy continues to ramp up. According to a forecast from Emergent Research, digital avatars could be worth more than $525 billion by the end of this decade. My very own avatar, yes, helps explain. Take a listen. Joining us now is a very special, slightly weird guest. It is, in fact, my own digital avatar, Tom McKenzie. Tom, Digital Tom, welcome to the show.
Thank you, Tom. It's a pleasure to be here on Bloomberg TV. I am an AI-powered digital avatar designed to provide insights and information on a wide range of topics.
Okay, this is all very odd. All right, what exactly are avatars?
Digital avatars, powered by generative AI, are virtual representations of individuals that can mimic human behavior, appearance, and interactions. They work by utilizing AI algorithms to analyze and learn from vast amounts of data, including facial expressions, gestures, and speech patterns. This enables them to generate realistic and responsive virtual characters.
Okay, so avatars aren't just gimmicks then, but what are the real-world implications? I'm thinking across the economy, across different industries. What is the impact actually likely to be?
They can revolutionize industries such as entertainment, gaming, and virtual communication. Avatars have the power to enhance user experiences, enabling immersive virtual interactions and personalized content. They can facilitate remote collaboration, telepresence, and even assist with customer service.
Okay, there have to be some downsides, though. So what are the risks of this kind of technology?
As AI becomes more pervasive, ethical concerns arise, including issues related to bias and fairness in AI algorithms, transparency and explainability of AI decision-making, data privacy and security, and the potential for AI to perpetuate existing social inequalities.
Okay, you're seeing like a trio of Toms. It's all very confusing. That was my digital
this. My dream
avatar.
Tom. 3 Toms at once.
It's your nightmare, Francine, let's be honest. And so this is a company. So what we did, we decided, there's a lot of talk about avatars, digital twins, the risks, of course. We wanted to know how you make them, so we went to this studio and had it all made up. It's a company called Synthesia. They want the kind of cutting edge of these digital twins. And then we layered on top of that ChatGPT. That powered the responses.
Yeah.
So that's what you're seeing there.
Yeah, I mean, I imagine as, you know, power processors and the chips actually become really more advanced, and will I ever be able not to tell the difference? Because that would freak me out. If there's like real Tom and not real Tom and I can't tell who's who.
Yeah, and you were saying that, Blake, look, the voice is a little bit different. And certainly there's like northern iterations. Yeah, slightly robotic, isn't it? And there's a bit of a northern twang. But you can imagine, you know, we know this technology is developing at a very rapid pace. So you can imagine it's not that far off where it's going to feel very, very natural indeed. And so the upside for companies like Synthesia, they say, look, you can get conglomerates, you can get the CEOs, the executives putting out global messages to their teams in multiple different languages. So they have partnerships, they have deals with companies like WPP and McDonald's and Ocado. Of course, the risks are deep fakes, and Synthesia says we don't do deep fakes. They have the processes in place to protect against that. That is a concern. And of course, job displacement as well. I asked my own avatar, are you going to take our jobs as anchors? They said no.
And he said yes?
He said no, because you've got charisma. And again, you know, that certainly applies to you, Francine. I'm not sure.
Peut-être.
Yeah, peut-être. Yeah, peut-être.
I would pay, actually, to hear you speak Spanish.
Well, there we go. That is now an option, yeah.
I love that. I mean, it's so good. Thank you so much, Tom, for that really, really incredible package. Coming up, hedge funds are willing to pay a high price to hire the best traders. More on the increasing fight for talent next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Happy Friday. 42 minutes into the European Open, you're seeing gains of 0.6% across European equities. Futures in the US looking to build on the gains of yesterday. S&P E-minis up 0.3%. Now to the banking sector, and specifically Goldman Sachs, warning investors of a sharp slowdown in its investment bank from the bumper gains a year ago. The bank's president, John Waldron, says He sees a contraction ahead. Let's get more then with Bloomberg's Leo Sherpa. Leo, Goldman Sachs warning again investors in terms of the trading part of the business, investment banking part of the business. There's going to be a slowdown. It's going to be quite sharp and dramatic, and there are going to be implications for jobs again at Goldman Sachs after the cuts we've already seen being pushed through.
That's true. So the President Walton spoke at a conference hosted by AllianceBernstein yesterday and basically said he sees trading trending down 25% compared to last year this quarter. So, and that's basically another bad headline for Goldman at the moment, because they're also working on job cuts that are going to affect more senior people this time. So a third round of job cuts in a very short time frame. So news flow is not looking good at the moment for them.
All right, thank you so much, Leo Sherpa there with the very latest of Goldman Sachs. And the big question is this a Goldman Sachs problem, or is it more of a problem for the industry as a whole? Now, paid sabbaticals and huge signing bonuses are just some of the rewards that hedge funds are using to hire and retain top traders. And in this costly war for talent, it is clients who are footing the bill. That's the subject of today's Bloomberg Big Take. Well, Nishan Kumar, our hedge fund reporter, joins us now with the very latest. Nishan, first of all, congratulations on a fantastic story. I know we'll travel far and wide because it's a deep dive look at really the hedge fund industry. So what's the talent war looking like?
It's really incredible. I haven't seen anything like this, but I have only covered hedge fund for 7 years at Bloomberg. But I spoke to several people who have spent like more than 3 decades, and they haven't seen anything like this either. So it's quite extraordinary, not only from the angle of the extent of payout in real dollar terms, but also, how hedge funds have discovered different ways to pay these compensation to traders. So signing on bonuses, which is guaranteed if you ditch your existing employer. They will pay you a higher cut of your trading profits for the initial profits generated, maybe for a year or maybe on your first $100 million of P&L. Also, if you have left your deferrals at your previous firm, that's paid out as well. And during your break for 1 year non-compete, that's taken care of as well. So it's almost sort of paid holidays. And these are not just salaries, but a lot of money.
It is amazing. You start with this fantastic anecdote at the top of the piece about a portfolio manager being offered, we're not talking dangling of carrots, we're talking dangling mountains of gold, $120 million and paid sabbatical. Explain to us what is driving this war for talent. Is this not enough talent out there? Is it because some of these hedge funds are suddenly performing better than expected? Is it because their investors are allowing them to and happy to pay for this and cover this kind of comp? What is going on in terms of that need to attract this talent?
So a lot of things is leading to this huge payouts and war for talent, and essentially it's the lack of supply. So after 2008 financial crisis, prop desks were shut, and that were good training ground for a lot of traders. That no longer exists, so the supply is constrained. And if you look at the growth of these multi-strat platforms, it has been phenomenal. Most of these players have added tens of billions of dollars to their assets. Most of the large players are close to new money, so they cannot take any more money. Only way they can grow is by hiring more people who could take more risk so that they could raise more capital. It's not a problem about raising capital at all for these hedge funds.
Nishan, who's paying for all of this?
Of course, like investors. Maybe they don't know all the cost that they are paying, or maybe they don't want to know all the cost they are paying, but they are footing the bill. One investor calculated the numbers for us, estimated that number for us, and he said that they're only getting now 45% of the trading profits generated, risking their capital, and hedge funds are keeping the majority of it. But investors are not complaining about fees because the returns have been phenomenal. Just for example, S&P 500 this century has produced about 7% annualized return. And most of these large multi-strats, their returns are in excess of 10%. And that has come with very low volatility. So people are willing to pay a price for that, pay a premium for that. Multi-strats just let you sleep well at night. And that's what people are happy to pay for.
Yeah, and happy to pay a lot for it. It's such a good read. It's the top of red right now. Hedge funds and the war for talent and the price tag involved. Nishan Kumar, our hedge fund reporter, thank you for the details. Coming up, South Africa considers moving the location of the BRICS Leaders Summit this August. That's amid concerns about an international arrest warrant for President Putin. We are live in Cape Town with more on that story. That is next. This is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open, everyone. 50 minutes into the European trading day. The picture across the board for a lot of these European stocks gaining between 0.6 and 0.7%. Of course, the focus on the jobs data. Will it be a number to actually blow out expectations of no hike from the Fed in June? Now, Bloomberg has learned that Turkey's President Recep Tayyip Erdogan is set to announce Mehmet Şimşek as his new Treasury and Finance Minister. Bloomberg's Simin Demirkan joins us now from Istanbul. Simin, first of all, he's a market darling. He is known, he is liked by the markets. Does this suggest that President Erdogan is about to step back from calling the shots on central bank policy?
Hi, Francine. Well, it's currently too early to tell. However, as you said, what we know by Mehmet Şimşek is that he is a market darling. He is trusted by international investors for his defense of orthodox monetary policy. And this could signal that this is exactly why President Erdogan wanted him back. Of course, over the past few years, Turkey, encouraged by Erdogan, has been following unconventional economic policies, such as extremely low interest rates despite surging inflation, which is still at double digits. So this is what investors will be looking to see. Will Mehmet Şimşek signal that there will be a policy pivot, and will he also demonstrate that the Turkish Central Bank will re-establish its independence as well as economic policies, be going back to conventional ones? So the cabinet will be officially announced on Saturday.
Okay, so we wait for Saturday to get the official announcement around who else is going to be populating this cabinet. What has the market reaction been so far, Simin?
Yeah, overall, it's been a positive picture ever since Bloomberg broke the story that Mehmet Şimşek will have a place in Erdogan's government as the Treasury and Finance Minister. Of course, he will replace Nurettin Nebati, who's been in that role since late 2021. We're seeing that Borsa Istanbul is up more than 3%. Banking shares have surged. Over the past week, there was a lot of speculation about Şimşek coming back, and that's helped the lira pare back its losses. But of course, it's still near record lows, surpassing 20 per dollar. But again, Mehmet Şimşek will really need to send a strong signal to international investors about what Turkey's economic policy looks like going forward. And what investors will really be looking at is for a revamp of those unconventional economic policies that we've had over the past few years.
Simon, thank you so much. Simon Demirkan there with the very latest, of course, on these new appointments in Turkey. Now, sources have also told Bloomberg that South Africa is considering switching the venue of an upcoming summit of BRICS leaders to another country. The move would resolve a dilemma over whether to execute an international arrest warrant for Russian President Vladimir Putin. Bloomberg's Africa correspondent, newly minted Africa correspondent, Jennifer Zabazaja joins us now from Cape Town. Jen, good morning. So why is South Africa weighing moving the event, and how serious is this consideration?
Yeah, Fran, I mean, as you mentioned, it could potentially resolve this dispute, something that a lot of people have been talking about since South Africa was announced as the host of the 15th BRICS Summit. But it's definitely still a consideration at this point, though. Based on our reporting, though, on Thursday, there are considerations about the BRICS Summit potentially moving it to either Mozambique or China. China is also a member of the BRICS, but it's still just a consideration at this point. And as you mentioned, this all is derived from this ICC warrant for Vladimir Putin for alleged war crimes. And so South Africa, as a signatory of the ICC, has needs to arrest Vladimir Putin if he were to come here. And so this has really caused a lot of concern in the investor community, a lot of concern domestically and in the foreign community. But what we heard from foreign ministers on Thursday that are meeting here in Cape Town is that the plan is still to host this event in August in Johannesburg. Whether or not it will see the arrest of Vladimir Putin is unclear, but South Africa is still planning to do it, and we'll hopefully hear from the president at some point about whether or not they're going to explore other legal options so they don't have to actually resort to this.
Yeah, and Jen, of course, Vladimir Putin's war that he has waged in Ukraine and the responding sanctions, largely from the West, but other countries as well, that's led to a rethink in terms of money flows and currency and the primacy of the US dollar. How close are the BRICS really as they weigh up their own currency? Is this a pipe dream?
Well, I mean, Tom, if you look at some of the messaging that we heard on Thursday, it sounds like they're taking this very seriously. I mean, one quote that we heard from the BRICS foreign ministers is that they're expressing concern about unilateral economic coercive measures, such as sanctions, hurting developing economies. And it's not too hard to infer that they're possibly talking about the U.S. And so, as you mentioned there is a proposal, there is consideration to potentially come up with their own currency derived potentially of physical assets so they can skirt the greenback, as we're seeing largely in a lot of other countries. Of course, we saw China and Brazil come up with their own trade deal to not use the dollar. And so this is potentially a consideration. And we heard from Sergei Lavrov on Thursday, he's also here in Cape Town, saying that, you know, it's unclear whether or not they are going to accept any members into BRICS if they support sanctions. So really at the top of the agenda for a lot of foreign ministers here.
Bloomberg's Africa correspondent Jen Zabasaja in Cape Town. Thank you. These markets, equity markets here in Europe, gaining 0.6%. The futures also in positive territory for the US. That is it for the European market open. Surveillance early edition is up next. This is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Global equities rally ahead of today's U.S. jobs report amid speculation that the Fed will hold off hiking rates this month while oil gains before this weekend's OPEC Plus meeting. The debt ceiling bill clears the Senate, removing the risk of a U.S. default. The measure now goes to President Biden for his signature. Plus, Bloomberg understands that Mehmet Şimşek will become the new Treasury and Finance Minister of Turkey as President Erdogan tries to shore up market confidence after elections. Now, first thing is first, so let's check on the markets. A lot of the focus, of course, is on the China tech rally. A lot of the focus is what we we understand, have from the Fed, which is a Fed hike in June. All of that could change because of the U.S. jobs report later, but look out for any change in treasuries and also some of the T-bills that are now really going a sigh of relief after that debt default has been averted. European stocks gaining some tenths of 8%. A lot of the focus is not only on the banks, but real estate. Futures in the U.S., 0.3% higher. It's really some of the driver that we're seeing, for example, with the tech in Asia that's filtering through optimism in Europe. And then Turkish lira, this is a Bloomberg scoop, a beautiful or important Bloomberg scoop, that there is a market darling, Mr. Şimşek, that was finance minister about 15 years ago, that could be appointed as soon as Saturday, and this would really give a bit of a sigh of relief to the markets, thinking that Mr. Erdogan is less now market averse. So you can see Turkish lira 20.8804. Now, the Senate has passed legislation to suspend the U.S. debt ceiling and impose restraints on government spending, ending a drama that threatened a U.S. financial crisis. The measure now goes to President Biden for a signature, a move that's been welcomed by Majority Leader Chuck Schumer.
This demanded a bipartisan solution. We knew we'd need to come together for a solution like the one that passed tonight. And so I'm happy to stand here passing this critical legislation to support our families, preserve vital programs, and most importantly, avoid catastrophic default.
Well, after the vote, Treasury Secretary Janet Yellen had a message for lawmakers. She said, "I continue to strongly believe that the full faith and credit of the United States must never be used as a bargaining chip." Let's bring in Bloomberg's Roz Matheson with the very latest. So, Roz, what makes up the deal?
Well, in its broadest sense, what it does, it takes it off the table through the US electoral cycle next year. It caps spending for 2 years. Again, that takes it out of the electoral machine through the 2024 presidential election. We know it's going to cap spending. There are some specifics in terms of students will have to start repaying their loans again. There'll be restrictions on some services and benefits for poorer people, for example, and we know a pipeline's going to get through. But there's a lot we don't know. It has to now be discussed and argued further, and that's sort of $64 billion potentially that has to be agreed in the near term. And what does that mean? That means certain services are going to have to be cut, but that's going to be a really painful debate between ultra-conservatives again in the Republicans and the progressives in the Democrats, and they have to get that done by October. So we're going to see more of the actual specifics come out now. The broad deal's done, but they've left a lot of the work on the table.
So, Roz, I mean, is this something that President Biden can go and sell to the American people as a win as we are in this election cycle?
Well, he's going to start that tonight. He's going to have an address to the nation this evening where he's going to spell that out. Of course, he's got to sign the deal, which is really just a pro forma thing at the moment. But of course, most American people are probably pretty tired of this and just relieved that it's done. It's really exposed again how polarized Washington is, very messy disagreement. At least that's off the table now. So they're probably relieved about that. Of course, President Biden doesn't face any kind of serious challenge in the primaries. The left will line up behind him during the election, and this shows he can actually negotiate across the aisle. So that for him is a positive, potentially. Really, the danger, if anything, is for the Republican Speaker of the House, Kevin McCarthy, who may face a rebellion in his own ranks next week.
Yeah, not even Jamie Dimon. I mean, that's a question mark, right? Everyone's kind of saying, is he running? Is he not? What party?
Well, if he's going to run, he has to decide in the next couple of months.
So let's see. Roz, thank you so much. As always, Roz Matheson, they're looking at this very important U.S. debt ceiling. Now, off the back of the debt ceiling, traders now turn their attention to the Fed's fight against inflation, whether there is a pause or hike in rates in June. Joining us for more is on markets is Chief Investment Strategist at iShares EMEA at BlackRock, Karim Shadid. Karim, thank you so much for joining. I mean, this is a big day, actually. I feel like it's the longest, and a viewer just wrote in, it's like the longest 4-day week that he's ever experienced. In general, when you look at what the market's pricing in for June, does it mean that we don't care as much as the jobs report today, or could it really change everything? So, you know, we should be on tenterhooks.
It definitely has felt like a long 4-day week, but with all the data we've had to consume. But looking at the payrolls, I think, you know, the Fed's going to be looking at the participation rate and at the unemployment. If we see any budge there, any sign of slack. But you're right. I mean, for June, it seems to be largely off the table. The question is more around July and what they do after June. Is it a skip? Is it a hold?
So what do you think will happen? And again, does it change what the market thinks the Fed does in you know, December or even October, November, December in terms of cuts?
I mean, the key thing for us is that the Fed is not going to cut this year. You know, even if we see some sign of slack, that's what they want to see. And even then, we still have a lot of pressure in wages in the labor market. Macro data has been fairly resilient in the US in Q2. We expect them to want to see some sign of slowdown, some sign of slack come up in the labor market, and the key thing is they don't react to it, they don't cut.
But I mean, I guess what I struggle with is the fact that the market is very abrupt in thinking that actually things are fine, things are not fine. Certainly the data from China has been very confusing. Some of the earnings data also from shares has. So how do you see this playing out through the summer?
Yeah, I think Q2 has been very interesting so far because we've seen the market interpret Europe and EM, even China, somewhat in a Goldilocks scenario where inflation has started to fall, growth in Europe has been better than expected, in China starting to fall a little bit. So really that Goldilocks trend, and it really comes through in the ETF flows with investors buying a lot more European and EM equities than they have US equities. So as we go into the summer, it's the evolution of that. Do investors start, does the market start to anticipate that that Goldilocks trade in Europe and EM is over? And do they start to apply that to the US, or is it more of a harder landing in the US? That's going to be key.
And again, the difference I find surprising between what Europe is doing and what the US is doing. So the US, in broader terms, the economy seems very resilient, especially when you look at labor. Here in Europe, we're seeing cracks, and actually we're seeing a lot of the ECB policy filtering through to inflation. So is that because of the composition of the economies, or the US is just doing much better?
Yeah, so I think in Europe, we have had some help from the fall in the food and energy prices, which have always been a bigger component of the inflation piece. So you see that that fall from the headline. But when you dig deeper and looking at the core CPI yesterday, I was just looking at the breakdown of the numbers, you know, a bit of a deeper look. We do have those pressures in Europe too. They might not appear at the headline as much, but they are here. Look at the German wage data, for example, over the past couple of months. It's similar to the US story, maybe different drivers in terms of the tightness of the labor market, but certainly some pressure. So I wouldn't get too carried away with assuming that Europe is in a different spot on that.
Okay, so what are you expecting from the ECB? Is it better to invest when you look at the flows, certainly in you know what you do and your iShares?
Yep.
Do you see a difference between actually investor appetite for Europe and the US?
Yes, so looking back, there has been a big difference. Investors have been trading Europe like a Goldilocks trade, a lot more money coming into European equities. That was helped by the China reopening for sure, you know, the consumer discretionary, the luxury names that we've been all following closely. They've seen a lot of buying from ETF investors, whereas in the US it's been more sluggish. Frankly, the flow picture in the US has been as concentrated as the rally. You know, the rally has been concentrated in tech, the flows as well. But as we look forward, you know, looking at the ECB, I think there is room for hawkish surprise there. There's the market's pricing a couple more hikes, but then it's starting to price cuts later.
That's interesting.
So I don't think that would happen.
And what do you do with China, the big unknown? One day it's doing great, the other
Yeah.
one we need, you know, a lot of support from policymakers.
Yeah, and this short week has had a mix of both. We've had bad and good data from different PMI releases in China. So it's definitely not been an easy one to analyze. But I think with China, the key theme is that policymakers do have a bit of room to ease should they want to, because deflation has been a key feature of the China reopening. And that's a key difference versus developed markets where inflation has been the feature of the reopening.
Karim, thank you so much, as always, for joining us. Chief Investment Strategist there, iShares, EMEA, and BlackRock, Karim Shadid. Coming up, the return. Turkey's president brings back Mehmet Şimşek as finance minister, so we'll bring you the latest on that. And this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, you know, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're getting some breaking news out of Brookfield among some of the investors in early talks on SBB asset sales. Again, Brookfield has been definitely in the news because of its acquisitive stance. over the last couple of months, and I would say quarters. And at the moment, you can see SBB, the unpronounceable SBB. Joe Easton was telling us this story just yesterday, gaining 24% on the back of it, as there is Brookfield interest in early talks for some of the asset sales that SBB is trying to put in place. Now, Bloomberg has also learned that Turkey's president, Mr. Erdogan, is set to announce Mehmet Şimşek as his new Treasury and Finance Minister. Well, Bloomberg's Simin Demokan joins us now from Istanbul. So, Simin, thank you for joining us once more. Does this suggest that President Erdogan is about to step back from calling all the shots on the economy?
Hi, Francine. Well, that's too early to turn right now. However, what we do know about Mehmet Şimşek, of course, he used to be Turkey's finance minister before, is that investors, they know him, they trust him, and they respect him for being the defender of orthodox monetary policies. He used to be a banker at Merrill Lynch. And of course, President Erdogan really needs to improve market sentiment. And this is maybe exactly why Erdogan wants Şimşek back. Şimşek will be the finance and treasury minister. And investors will be looking to see if he signals quite early on whether he's going to have a policy pivot. For years now, encouraged by President Erdogan, Turkey has been following an unconventional economic policies, which includes low interest rates despite sky-high inflation, which is still in double digits. Late last year, it surged to a 24-year high. So Mehmet Şimşek will replace Nurettin Nebati, who came into that role late 2021. And of course, as I said, he'll be having to send strong signals to investors pretty soon because they're looking for answers.
They certainly are. So what's been the market reaction so far, Simin?
Yeah, overall today, ever since Bloomberg broke the story that Şimşek will come back as finance minister, we've seen a positive market reaction. Borsa Istanbul is up more than 3% so far today. The banking index up more than 6.5%. But of course, the lira is still near record lows against the dollar. However, speculation over the past week that Şimşek would come back has pared some of his losses for the week, but it's still trading above 20 per dollar. So what investors are really looking for is, will Mehmet Şimşek signal a pivot in policy, as well as re-establish central bank independence and independence for economic policies without President Erdogan being too involved?
Simin, thank you so much. Simin Demokan there with the very latest on Turkey. Now, oil inching higher, still on track for weekly decline. That's as OPEC and its allies prepare to meet in Vienna over the weekend. The oil cartel will discuss output and the state of the sector against the backdrop of global economic uncertainty. Let's get more now with Bloomberg's Manus Krani, who's also heading to Austria. Manus, so first of all, good morning. What are the biggest risks as we look to the meeting?
A lack of consensus. Not only is the China recovery faltering, but there's a lack of consensus and a lack of cohesion, I would say. There is so much oversupply from Russia, from Iran, and from Venezuela, those sanctioned nations. That supply is something that's getting very difficult to control. Russia was supposed to cut much more aggressively and faster in reaction to the sanctions. That hasn't happened. Here we are on this road to Vienna, and I can tell you that there's a real vexation out there. The blame game has been that the speculators were responsible for taking oil down from the $90, $100 range down to this $70 area. We've had a fairly tough week as well. The daily vicissitudes of the debt ceiling have not granted any pro-risk in the oil market, but there's been three major attempts to perhaps control the narrative. 100,000 barrel cut in September when oil was at 92 million barrels, albeit a paper cut. That was in the autumn. We were at $90. And then in April, there was an uncodified or a voluntary cut of 1.2 million barrels. That's when we were at $80. And I should say that, you know, Saudi Arabia has done the heavy lifting. They have cut by 500,000 barrels, but it's the Russians who are not delivering at pace as perhaps the overall OPEC group want. The risk is, Francine, a lack of cohesion at the end of this weekend, and that is a real material issue. Will the Russians cut more? There just doesn't seem to be that overarching desire to cut, but then, of course, you've got to build a consensus for that. We'll be on the ground, chasing ministers. We're already chasing them. The print team are there. I'll go tomorrow, and we'll have full reports on Monday morning. For any minister that fancies giving me a call right now, you're very welcome on TV outside OPEC headquarters at any time.
Yeah, outside, but we know OPEC is excluding some reporters, so I also hope, Manus, that they change their mind, and of course Bloomberg will be allowed inside. We will give you the number, though. Everyone should call Manus and give us exclusive interviews on Manus Cranny. They're on the ground in Vienna from this weekend. Coming up, South Africa, set to be considering switching the location of the upcoming BRICS summit. It's facing a dilemma over an arrest warrant for Russian President Vladimir Putin. We'll bring you the story next, and this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas, and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that Jamie Dimon is to visit Taiwan after wrapping up his high-profile trip to China. The stop-off by the JP Morgan CEO comes at a time of heightened tensions between Beijing and Washington. LVMH CEO Bernard Arnault, meanwhile, has become the latest big company boss to announce plans to visit China as Tesla's CEO Elon Musk returns from his whirlwind tour of the country. Now, Rishi Sunak's administration has refused a demand from the UK's COVID-19 inquiry to hand over former Prime Minister Boris Johnson's WhatsApp messages and pandemic diaries. The government's Cabinet Office says it's filing for a judicial review into the request for those documents. The move sets up a legal battle that risks amplifying accusations over a cover-up. Now, the Pentagon is to buy Starlink satellite communication terminals and services from Elon Musk's SpaceX for use by the Ukrainian military. The US has praised the role that the terminals have played in Kyiv's war efforts, seeing them as vital for the country's defense. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, sources have told Bloomberg that South Africa is considering switching the venue for an upcoming summit of BRICS leaders to another country. The move would resolve a dilemma over whether to execute an international arrest warrant for Vladimir Putin. Well, Bloomberg's Jennifer Zabazaja now joins us from Cape Town. So, Jen, good morning. Why is South Africa weighing moving the event, and how serious is the consideration?
Yeah, Fran, I mean, it really is a consideration at this point in time because, as you mentioned, the arrest warrant for Vladimir Putin by the ICC has been causing a lot of concern and unnerving a lot of domestic investors and also foreign investors because South Africa, as a signatory of the ICC, would have a duty to arrest him if he were to come. But still, what we're hearing from the foreign ministers here in South Africa, because they are here gathered in Cape Town, is that the BRICS summit, the 15th BRICS summit, supposed to be held in August, is going to go as planned in Johannesburg for what, for as far as we know at this point in time. And what we heard from the foreign minister yesterday is she's really discussing and really reiterating South Africa's stance as a non-aligned state and saying that the president is going to continue to explore legal options. But at this point in time, the country is still planning to hold this summit, which could potentially stir a lot of nerves for a lot of people domestically and also globally, Fran.
So, Jen, where's this bloc on potentially creating its own currency?
So it's part of the top lines of the agenda here at the BRICS Foreign Ministers Summit here. Today is the Friends of the BRICS Summit, and so we're going to see a lot of foreign ministers from places that are looking to become a part of this bloc. Think places like Saudi Arabia, the UAE, and also Kazakhstan. But really what we heard on Thursday, the messaging that we heard, is they're really trying to create a bloc that is potentially shaped up for a rebalanced world and can really exert their own influence. And so part of that has to do with this currency, as you mentioned, and what we heard our sources are saying, it could potentially be a way for some of these countries to evade sanctions. One specific quote that really stuck out to me was one of the foreign ministers saying that they expressed concern about unilateral economic coercive measures, such as sanctions threatening the developing world. And of course, you can infer that they're potentially talking about the U.S. And so right now at this stage, this currency, this debate discussion is really just at the proposal stage. But we've heard from a number of these foreign ministers just continuing to express their concern about the dollar and about the dominance that the dollar has had over their own nations at this point in time, and really a trend that we're seeing globally.
Jen, thanks so much. Jennifer Zabazaja there in Cape Town. Coming up, the market for AI avatars is forecast to ramp up rapidly. Our Tom McKenzie joins us next with help from his very own digital avatar. This is Bloomberg.
think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Global equities rally ahead of today's U.S. jobs report amid speculation that the Fed will hold off hiking rates this month. Oil gains before this weekend's OPEC Plus meeting. The debt ceiling bill clears the Senate, removing the risk of a U.S. default. The measure now goes to President Biden for his signature. Plus, Bloomberg understands Mehmet Şimşek will become the new Treasury and Finance Minister of Turkey as President Erdogan tries to shore up market confidence after elections. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the AI frenzy is continuing to ramp up. Wall Street banks already use the technology, but it's growing fast in other business sectors, too, like media and e-learning. According to a forecast from Emergent Research, digital avatars could be worth more than $525 billion by the end of the decade. Well, let's bring in our very own Tom McKenzie with just a wonderful, wonderful, fun story. Fun and also a little bit scary, Tom.
Yeah.
So you created your own avatar.
Yeah, there's been a lot of focus and talk about AI, of course, generative AI. One part of that are these digital twins, digital avatars. So we went to a studio in East London, worked with a company called Synthesia. They're at the cutting edge of some of these videos and some of these digital avatars, and we got one made. So take a listen. Joining us now is a very special, slightly weird guest. It is, in fact, my own digital avatar, Tom McKenzie. Tom, Digital Tom, welcome to the show.
Thank you, Tom. It's a pleasure to be here on Bloomberg TV. I am an AI-powered digital avatar designed to provide insights and information on a wide range of topics.
Okay, this is all very odd. All right, what exactly are avatars?
Digital avatars, powered by generative AI, are virtual representations of individuals that can mimic human behavior, appearance, and interactions. They work by utilizing AI algorithms to analyze and learn from vast amounts of data, including facial expressions, gestures, and speech patterns. This enables them to generate realistic and responsive virtual characters.
Okay, so avatars aren't just gimmicks then, but what are the real world implications? I'm thinking across the economy, across different industries. What is the impact actually likely to be?
They can revolutionize industries such as entertainment, gaming, and virtual communication. Avatars have the power to enhance user experiences, enabling immersive virtual interactions and personalized content. They can facilitate remote collaboration, telepresence, and even assist with customer service.
Okay, there have to be some downsides though. So what are the risks of this kind of technology?
As AI becomes more pervasive, ethical concerns arise, including issues related to bias and fairness in AI algorithms, transparency and explainability of AI decision-making, data privacy and security, and the potential for AI to perpetuate existing social inequalities.
Well, I mean, that was fun, and again, very, very freaky. So what are some of the ethical concerns surrounding this? This is not deep fake, right, which we really need to put an accent on.
Yeah, so Synthesia, the company we worked with to create this, and then we got ChatGPT to give the responses. Synthesia define deep fakes as images and video that already exist that is then manipulated. They say they don't do deep fakes because they create it original. This is original content. I went in there, I recorded my voice, I recorded my image, and they built the algorithm, they built the digital avatar on the back of all of that data. But that is a key concern. You're absolutely right to flag that. We've had examples in countries like Venezuela, for example, of people using deep fakes to try and push their own political ends. Synthesia says, look, we've got the systems in place to try and avoid that kind of scenario, but kind of nightmare scenarios, you get a leader, president or a prime minister, the video is manipulated, they make some big decision. So that is a clear risk. And then, of course, job displacement. To what extent are they going to lose jobs? Synthesia are very clear. They don't want companies to be using video production teams. They want you to go to them, build the avatar. So there's a job loss there, clearly. But it's not hard to imagine that in a couple of years' time, streaming companies making films and TVs could be using digital avatars to replace actors. So that's another area. And that's just when it comes to these digital twins. Generative AI, there's all sorts of questions about the music industry, arts, of course, and writers and script writers. So those are some of the concerns that are being flagged. But for a company like Synthesia, they've made about 15,000 videos. For the likes of WPP and Ocado, they're backed by a lot of money. For them, they see this as very profitable. The market itself seen as about $500 billion by 2030.
I mean, in the music industry is a huge concern because a lot of the musicians actually record, note by note, and they did the synthetic AI-generated Drake, and so that blows up the business model completely.
Yeah, the AI-generated Drake, raised a lot of eyebrows and got a lot of discussion within the music industry. So it's a live topic, absolutely.
Tom, thank you so much. Tom McKenzie there with his very own avatar, 3 Toms on set. It doesn't get better than that. Now, joining us for more on AI is Felix Capital founder and investor, Frédéric Cour. Felix Capital is the largest European VC in terms of assets under management to reach B Corp certification. Thank you, Frédéric, for joining us. B Corp certification. I mean, I don't know whether that also warrants its own avatar, but you're certainly at the cutting edge of a lot of the things that you've been investing in terms of retail, in terms of e-commerce, in terms of how technology has changed the way that we live and breathe. How will AI change that even further?
So that's exactly the point. What we do at Felix is that we follow, we back founders and are using technology to basically change the way we live, the way we work, the way we communicate, the way we get entertained, etc. So with AI, it's a whole new playground, basically, and we expect a vast impact on our daily life. But I think a vast impact that will be so strong that we will not see it, basically. It's going to be about AI getting into our daily life without us seeing it. Like talking to someone. Right now it looked a little bit odd, that kind of slow.
The voice was a bit robotic.
Yeah. So it's only the beginning. At some point you will be talking to someone, maybe calling a brand, calling a business, booking a hotel, talking to a machine, and having a great experience. So this is only a question of time.
But so do you have, and I don't know whether I should ask you philosophical questions, but should entrepreneurs, VCs have a problem if a human like me cannot tell whether I'm speaking to another human or to an AI-generated avatar?
So usually technology is ahead of both usage and regulation. So all of these things are going to come together. You talked earlier about music. Remember when Nasper came and we thought it was the end of music. And look, fast forward 15 years later, the music industry is all about streaming. So we expect that this is what's going to happen. Usage and regulation are going to follow. And we definitely need to find the right ethical environment and for user technology.
I feel like I'm not downbeat on AI at all. I just feel like it's the first time that you don't put human, Napster means that I have better access to this as a human, whereas this you put technology before the human. What does it mean for your investments? Are you looking at places where it's disrupted, or do you use it, for example, to find companies?
Yeah, we use it, we see AI having a big impact on our activity at 3 levels. One, how we work, trying to be more efficient, using technology, data, and in a more efficient way, automating some of our interaction with companies, that kind of things. Second, impacting the way our companies work. For instance, we invest in a company called Travel Perk, which is a very large corporate travel business, which has got over 1,000 people in the call center. That's going to be vastly transformed and impacting the OPEX margin by using AI, automating certain tasks. And then finally, what we do at Felix is all about creativity. So it's about changing the way we do things today, but also creating new habits. So in the same way that the iPhone and smartphone led us to Uber and Instagram, which have changed huge industries, we expect AI to be a new platform, and there'll be new things coming. We just don't know what they are yet.
So do you find enough capital? Is there enough investment coming to you that you can deploy and put capital to work?
Well, right now there is no, there is a lot of capital in the market. That capital at our end of the market is being invested and deployed more slowly compared to the past couple of years during the pandemic, and that's very healthy.
Recessionary risks, or?
Well, because I think it's also we're back to meeting people in person. I think real valuations have been reset. In AI, though, we've seen a lot of frenzy. It's kind of sometimes you think people don't learn their lessons. Some of the valuations at a point where business models are not proven yet seems way too high. At the same time, it reflects the scale of the opportunity.
We should chart the conversation on Bloomberg like, 6 months ago it was all about the metaverse. Now it's all about AI.
Well, but remember the metaverse. Remember the slightly awkward video of Zuckerberg explaining.
I remember.
And again, that was just the beginning, except that they didn't find a real usage. I think Web3, we talked a lot about it. It didn't translate into usage. What we see with ChatGPT today is the fastest digital service to be adopted online. That's very simple. I talked to my daughter yesterday. She was doing homework. Some of the questions that she was working on, she didn't generate them with AI, but she was kind of somehow powered by it.
Yeah, I hope the teacher's not listening. If the teacher is listening, please ignore it.
The teachers have to embrace it as well.
But for I guess the question is, you were one of the early investors also in Goop and some of the really mainstream things that we use every day. This is also through a search engine, so it's algorithms. I type, I don't know, I need this. It's a cream or whatever. If AI takes over that, and we have personal assistants, as an investor, do you need to think about how then they find your companies?
So we back a lot of brands, for instance, and that's very much powered by human creativity, because a brand is a lot of something you need, but also something you don't need.
We Google at the moment, right?
Yes, of course. So it's going to change the way we interact with technology. So you might just go to a website, and people are going to learn how to write prompts like they do on ChatGPT. It's going to be very different than writing a search on Google. So it's going to change the way we interact with a service, probably make it smoother. And so we expect a lot of innovation in terms of personalization, in terms of finding the right product faster, and just leading to a better experience.
Yeah, and I know you also focused, of course, on some of the sustainability play, which is why you bought a stake in, I think, in a French energy transition company called IFI. Is that going to be faster or slower than expected because of the war in Ukraine, the transition that we're going through into renewables?
So that's a good question. Obviously, these people are looking at their wallet. As price of energy go up, there's more an incentive to change the way your home is operating. Solar energy, for instance, is a massive trend. So that's why we backed the company going after installation of more solar panels in France and various other sustainability ways to have a more sustainable home. So you look at AI, sustainability. There are two big themes with very, very strong tailwinds where we want to get exposed for the next decade.
Is there anything else that you're looking at? Yesterday we had a half-an-hour special on the car industry in the UK and batteries. Is there still investment opportunities in these kind of things that will transform the way also
At Felix, we are more focused on usage, so we'll be more at the application layer than the deep technology. But obviously, mobility is going to continue to change. AI is going to get into cars. People want to have a more sustainable life, so they are going to embrace electric mobility faster. So we're looking at all of the implications at a consumer level, but also software level. So you need to plan for solar panel installation, for battery recycling, this kind of thing. So there are lots of new markets that are emerging. So we're in a world where what's not changing is change. A year ago, AI was there, but was not in the public and popular culture. It is here today, so that's very exciting for the future.
Yeah, and the pace of change is so much quicker. Frédéric, as always, thank you so much for joining us.
Thank you for having me.
Frédéric Ecourt, Felix Capital, founder and investor. We're just getting some breaking news out of Blackstone and Goldman actually leading a $1.6 billion deal for EQ2 take is private. So this is one of the companies. It's pretty incredible, actually. We used to talk about M&A Monday because a lot of the deals that were announced were on a Monday. Today, I feel like it's M&A Friday. We also had Blackstone being interested in certain assets that SBB was closing off. But Blackstone and Goldman together trying to back a deal and are now leading the $1.6 billion deal for EQ2 take private. So we'll have plenty more, of course, on that, and we'll see what that leads to in the coming days and weeks. Coming up, more pain ahead for Britain's housing market. We'll tell you why in a moment, and this is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jake Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May Jobs Report, today on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK housing market is sputtering again, with economists predicting that the downturn has further to run. That's as rising interest rates bite into consumers' budgets, with data this week showing prices have resumed their decline. Let's bring in our UK correspondent, Lizzie Burden. Lizzie, good morning. So hopes of a recovery seem to be fairly short-lived.
Yes, well, we've had inflation shock after inflation shock, including for core inflation in the UK. So that's why traders are now pricing a peak rate of 5.5%, which is above the danger level that the Bank of England identified for mortgage distress, debt distress for mortgage borrowers. And that's just looking to the future. You've still got previous hikes yet to feed through. We were speaking to former Bank of England policymaker Michael Saunders on the UK Politics podcast this week, and he said it's the next few quarters where you'll see the worst pain for the housing market. because the majority of mortgage borrowers in the UK are on fixed rates. And the Bank of England estimates that only a third of the rate hikes that have already been done have passed through already. So this is that lag in monetary transmission that the doves on the MPC refer to. It's a blunt tool, the interest rate. The pain is slow. And it's also, for the Prime Minister, Rishi Sunak, difficult because the Conservatives, of course, have long made home ownership meant to be their dream. He's made his #1 priority halving inflation by year end. If he can't do that, this pain in the housing market, the opposition will lay at his door.
Yeah, Lloyds Banking Group is also going through some of course, the mortgages. I mean, there's some of the smaller players that have also had to pull mortgages. I mean, it's just not a great time if interest rates are going to go up, but some of them are actually trying to buffer how much they can borrow and for how much.
Yeah, you've seen about 800 deals being pulled from the market, according to Moneyfacts. So it has echoes of the Liz Truss era, if we can call it that, last year. You've also had lots of other data this week. So the Bank of England mortgage approvals data dropping unexpectedly this week, but also an unexpected rise, unprecedented, I think, in how fast people are paying off their mortgages because they're afraid of what's in the pipeline. But you also saw in the nationwide data an unexpected drop in house prices. It's only modest. It's not going to do much to help those people who are trying desperately to get on the housing market, on the ladder, after this decades-long boom, especially in London. But our economists at Bloomberg Economics reckon you're still going to get a double-digit drop compared to the peak from last year. So this correction has a way to go.
Thank you so much, Lizzie Burden there with the very latest, of course, on houses and mortgages. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Goldman Sachs is warning of a sharp slowdown in its investment bank compared to the bumper gains a year ago. Its president, John Waldron, says the trading business is trending down more than 25% this quarter. Goldman is working on what would be its third round of job cuts in under a year. Now, Broadcom says artificial intelligence-related sales will double this year, but that won't be enough to offset a broader post-pandemic slowdown. CEO Hock Tan says AI-focused chip revenue may soon make up 25% of the company's sales. Total revenue is expected to rise less than 5% this quarter, Broadcom's slowest growth in years. The CEO of Palantir says new AI developments are so powerful that he isn't sure if they should even be offered to some customers. Speaking exclusively to Bloomberg, Alex Karp says he's wary about providing the tools to local law enforcement agencies for purpose such as surveillance.
Usually we have to go out and find people. Now we have customers, especially in the U.S., just calling us every day.
You said the demand is huge. Yeah. Can you quantify it in some way?
Well, you know, usually, we've had a number of inbound calls in a year that we usually have in a year in like a month. We're offering things that are so powerful that in reality, I'm not sure we should even sell this to some of our clients.
Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Coming up, hedge funds willing to pay a high price to hire the best traders. More on the increasing fight for talent next. And this is Bloomberg. what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Two pieces of news that could potentially actually lead to some major M&A. First of all, SBB has attracted Brookfield interest in a bid to rescue the landlord as it's selling off certain assets. And then the other one is Blackstone. Blackstone and Goldman leading a $1.6 billion deal for EQT take private. Now, also, paid sabbaticals and huge signing bonuses are just some of the rewards that hedge funds are using to hire and retain top traders. In this costly war for talent, it is clients who are footing the bill. This is the subject of today's Bloomberg Big Take. Well, Nishant Kumar, our hedge fund reporter, joins us now. Nishant, first of all, congratulations. It's our Big Take. I know you spent many weeks working on this. So how's the talent war going? How ugly is it?
It's very ugly, so it's leading. Yeah, in terms of money, but as well as it's leading to conflicts between hedge funds. It's leading to litigations. It's leading to, in one case, two firms basically banning traders from actually leaving once they sign on. Otherwise, they will be fined. So that's how ugly it is. But in terms of compensation, yes, this is a big number. I haven't seen anything like this, and I've spoken to many industry players who have seen this industry for more than 3 decades, and they haven't seen anything like this.
So why is it happening? I mean, where are we? And is it just attracting the best? It's basically to try and attract the best talent for, hundreds of millions of pounds.
Absolutely. I mean, what is driving this is the real dearth of good quality talent that these hedge funds are looking at. Essentially, in 2008 and regulations after that, prop desk disappeared, and that used to be the training ground for these traders. But that supply is no longer there. So, the talent, the good quality talent, experienced talent is getting circulated within a few large platforms. And that's why. And at the same time, these platforms have grown multiple times. Multiple times in the sense that they have added tens of billions of dollars. So they need ever more traders to manage that money and keep growing and keep earning higher and higher fees.
Nishant, thank you so much. Again, our top red story today, hedge funds at war for top traders dangle $120 million payouts. Nishant, thank you so much, Nishant Kumar. And then, of course, we'll also push it out on social media so that everyone can have a good read of this wonderful, important big take. Now, China is weighing some property market support package to boost the economy. This really has been the question of the week on whether we saw some data that was disappointing and whether that meant that we had policymakers in China needing to step in to try and at least find a baseline or a floor for the economy. Bloomberg Surveillance Early Edition continues in the next hour, and this is Bloomberg.
things that go wrong, and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site, whereas this we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Crisis averted. The debt ceiling bill clears the Senate, removing the risk of a U.S. default. The measure now goes to President Biden for his signature. Now attention turns to today's U.S. jobs report. The data may show a slowdown in the pace of hiring that could potentially allow the Fed to pause its tightening policy in June. And Broadcom predicts that sales tied to AI will double this year, though the chipmaker remains mired in a broader chip slowdown. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And Kriti, we are done then with the debt ceiling. That came and went. We're done with that through the House, through the Senate. But now we move on to the jobs report.
Yeah, we really do. It doesn't matter whether or not we get this relief rally when we are talking about potentially growth concerns at the end of the day. We go right back, snap right back into that inflationary story and what that means, not just for the Federal Reserve, but central banks around the world. And look, you're already seeing a little bit of optimism baked into futures here that perhaps we might get a little bit of weakening in the payrolls numbers. But don't let the green on the screen fool you, because even though futures are higher by about 0.4%, a big part of this story is getting in on this kind of tech-crazed rally. Essentially the idea that in the last couple of weeks, you have not only seen the kind of lack of breadth, but essentially the idea that a handful of names are really seeing very, very few sellers on the market. Even any pullbacks, even like the likes of what we saw yesterday, for example, not an enormous margin. So a lot of folks still kind of piling into the tech story, and by extension, the benchmarks as well, Anna. It's nevertheless 0.4 back on that futures contract higher. Again, that may change as we get that payrolls data. The 2-year yield also, of course, in focus, coming off the economic data, 433 on the front end of the curve, kind of unchanged right now, but really interesting to see that it has stayed sustainably above 4%. That just really reflects the idea that the market is pricing in a Federal Reserve that is simply not done hiking, which is why you're seeing that front end of the curve really sell off. So important to keep an eye on that and how that changes when we get the data in just a few hours. And of course, with the yields coming, or at least directionally moving lower, and you've seen that tick by tick overnight, the dollar is following down to the tune of 0.2%. latest weakness coming in the dollar based off of what you're hearing over in China, simply the idea that they are weighing a property market support package to boost the economy. That is a really important story when we talk about Chinese growth and how that's reflected in assets like the commodities market, which brings me to NYMEX crude, a 71 handle there, Anna. We are seeing a little bit of green on the screen. Of course, like I said, I want to come back to the currency picture because see this latest tick for our radio audience, stick with me, that tick lower, that weakness that you're seeing in the dollar relative to the offshore yuan coming off those China headlines. We are looking at 707 on that exchange rate, Anna.
Yeah, interesting. If we had seen some robustness in some parts of the Chinese economy, manufacturing and property were areas that people had concerns about. So that's an interesting red headline to keep under review then, Chrissy. This is the picture in Europe. We see a positive picture really for equity markets here in Europe, maybe getting another level of positivity coming through from those Chinese headlines around the property market. But broadly speaking, it's been a positive start to the trading day here for European stocks. And we're looking ahead to the jobs report, but comforted by the news that we have on the debt ceiling coming out of the United States. Make note of the bright area of green down there in the corner of the map. That is, of course, the Turkish equity market, and we'll come to that just now. I'll show you where we are on the Istanbul market because we've had some really interesting reporting from our colleagues out of Istanbul suggesting that Mehmet Semsek, who's somebody who was previously finance minister in Turkey and has been deputy prime minister in Turkey, could he be coming back to the top table, back to the cabinet under the President Erdogan? Well, that's what our reporting suggests. We'll get confirmation of that or not over the weekend. But if that were to be the case, he is somebody who is known, very much a known quantity for markets and somebody with a much more conventional take on financial policy or monetary policy than some of the other voices we hear from in Turkey. This is SBB. These are a couple of stories out of, that have a Scandinavian angle to them. This is SBB, the Swedish listed real estate business. This is the poster child for the troubles that the real estate sector has been in over in Sweden. And now we understand that Brookfield, the Canadian investment business, might be interested in buying the company, talking to the company about that, taking on some of the assets. We don't know. It's still early days, but the stock up by 26.5% as a result of the news flow surrounding that. And here's another story which has a Scandinavian element because EQT, the private equity business, is considering, has made an offer for Dechra Pharmaceuticals. This is a pharma company that makes pharma products, not for people, but for pets. A lot of money in that, it would seem. But they recently put out a profit warning, and that had led some in the market to question whether we would see this deal come to pass. The stock is up by 8.3%. And you had WTI, I've got Brent, Chrissy, as we just keep an eye on what's happening with this oil price as it edges higher, the closer we get to that OPEC Plus meeting.
Yes, certainly something we're going to be keeping an eye on throughout the weekend. But again, we are still waiting for that final seal of approval in Washington. The Senate passed legislation to suspend the U.S. debt ceiling and impose restraints on government spending through the 2024 election, averting a default. Senate Majority Leader Chuck Schumer spoke of after the vote cleared Congress.
This demanded a bipartisan solution. We knew we'd need to come together for a solution like the one that passed tonight. And so I'm happy to stand here passing this critical legislation to support our families, preserve vital programs, and most importantly, avoid catastrophic default.
Joining us now to break it all down, Bloomberg's Rosalind Matheson. Rosalind, can anything go wrong from here?
Well, unlikely to, because of course it's passed Congress, it's passed the Senate, just needs Biden's seal of approval. And of course he's going to address the nation later tonight in the US to talk to the American public about what this deal means. And so really it is a done deal at this point. And what it does most of all is it takes the debt ceiling off the table for 2 years. That means through the US electoral cycle in 2024, which is probably a big relief to everybody. So it's off the table for that. It caps spending for only 2 years, not 10. So obviously that also means it's off the table during the election cycle. But really, a lot of the deal is still unknown. We know there's going to be certain measures where students will have to start to repay their loans. We know there's going to be restrictions and perhaps cuts to some services for poorer people, but a lot of the detail still has to be worked out. And so the deal itself is fine, that's through, but really the reality is now we get down to the nitty-gritty on some of the deals, some of the spending areas that are going to have to be cut or trimmed. The Congressional Budget Office estimates $64 billion has got to be found, and pretty fast. That's a lot of money to find in the cupboard or behind the back of the couch. And so we can expect a lot of messiness going forward in the next couple of months, because that has to be agreed also by October.
Ros, how would you characterize what we've seen play out here around this debt ceiling debate? Because we spend a lot of time talking about the bipartisan infighting that we see in Washington, and we feared that perhaps some lawmakers might want their moment in the sun and make a big fuss and therefore push the US into some sort of default. That hasn't happened.
Well, that's right. We always expected it would go down to the wire because it makes political sense for either side to do that. But did you want to be the one that drove the bus off the cliff in the US? Probably not, going into the election. And so there was always the incentive to find a deal at the last minute. But really, for the American people, probably looking to the comments from the president this evening, they're probably just relieved a deal has been done and it's off the table. And for them, obviously, seeing the nastiness and the infighting that you talk about in Washington and the polarization, they're like, could you just get a deal and let's move on? Because for them, really, it's about things like the job market. It's about their employment and their security. And we'll see that in the jobs figures today. And it's really more for them probably about where the Federal Reserve is taking interest rates, whether those rates start to pause as the market is now expecting.
Okay, Treasury markets will no doubt adjust. We will mark our calendars, mark our diaries. December 2024. We'll get you back, Ros, to talk about the same thing again. We'll be back to talking about the debt ceiling. Bloomberg's Rosalind Matheson to bring together those threads from Washington. Now, Broadcom says artificial intelligence-related sales will double this year, but that won't be enough to offset a broader post-pandemic slowdown. Joining us now, Bloomberg's Alex Webb with analysis. Alex, walk us through the Broadcom results then.
Yeah, it was a fascinating set of numbers. The current quarter was broadly in line with analyst estimates. In fact, the outlook for the upcoming quarter was slightly ahead of estimates. But the full year numbers, it's only going to be about 5% growth. And when they talk about AI revenue doubling, it's doubling to $1 billion. It's for a company that has, significantly more than that. It's not like NVIDIA, which has, added 50% more revenue than expected from AI. This is really just some numbers around the edges. The full year, then, they're looking for now, my apologies, I'm just digging up the number. Yeah, so they're expecting 35 billion for the full year. 1 billion as a percentage of that, clearly not all that substantial.
And Alex, of course, that's the Broadcom story. Part of the Apple supply chain we should add as well. There's another major tech name reporting earnings, Dell Technologies, coming out, beating estimates, perhaps not enough to excite investors, though. Why is the stock down to the tune of 3.7% in the pre-market? Walk us through it.
It looks very much like it's to do with the full year outlook, which is sort of in line with analyst estimates, in fact, slightly below. They're looking at the low end of what analysts were expecting. That seems to have disappointed investors to a certain extent, even though the numbers in the current quarter were slightly better than had been expected. So it's really looking towards the full year. Of course, Dell benefited significantly during the pandemic as plenty of people and companies invested in more computing tools. Dell was a beneficiary of that. That makes it quite hard point of comparison when we look into this year, into 2023.
Alex, thanks very much. Bloomberg's Alex Webb with the latest on those tech themes. Let's move from tech to oil. OPEC Plus is meeting this weekend, and it will be grappling with a divided oil market that's torn between a rebound in demand and recession fears. Joining us now here in London, Will Kennedy, Bloomberg's Senior Executive Editor for Energy and Commodities. Will, good morning to you. So the market has been soft for the last few weeks. Do we expect OPEC Plus to change policy at this meeting? They did it in April. It was a surprise then. They did it in October.
I think it's hard to say as of Friday morning. I think the meeting is up in the air to some extent. As you said at the beginning, there are reasons for OPEC to perhaps consider steady as she goes or a further cut. The market is clearly soft and has not gained any traction from that surprise cut in April, and I think that will be a concern to some members and may want to do something about it. On the other hand, there is still this expectation that the market will tighten in the second half of the year and that global inventories will start to fall. And I think for any cut to take place, members will want to be reassured that Russia is going to participate. One of the issues is that it's not clear from the tanker tracking that we see that Russia has followed through on the 500,000 barrels a day cut that it pledged earlier in the year. And until that happens, I think some members will be reluctant to cut further.
I've got to say, it is pretty cool that our oil team gets to track tankers minute by minute. We, of course, applaud that team, as always. But, of course, the run-up to the meeting has been overshadowed by the bar of Bloomberg and other reporters being barred from the meeting. Will, talk to us about access when it comes to these developments.
Well, as we wrote earlier in the week, OPEC changed its policy for press. Normally, you could just apply to be accredited to the meeting. Now they sent invitations to reporters, and no Bloomberg reporter and no reporter from Reuters and many reporters from the Wall Street Journal did not get those invitations. And at the moment, as of Friday morning, we still haven't been invited, and as such, won't be be able to attend the meeting over the weekend. I mean, I think it's a great shame. Bloomberg has covered OPEC for 30 years, Reuters for longer. We want to be there, but we don't know why we're not. And we've asked the Secretariat at OPEC to clarify the situation. They haven't yet been able to do that. I don't think this is in line with their stated mission to bring transparency to oil markets, but the ball is in their court. All I can say is the whole team will be there as usual, covering the event as best we're able and bringing the news to all our readers and viewers.
Well, thanks very much. Bloomberg's Will Kennedy then, as we look ahead to those OPEC Plus meetings taking place at the weekend. Now, coming up on the programme, we'll get back to broader macro themes. We'll speak with Elliot Hentoff, State Street's head of macro policy research, on the growing headwinds amid a debt limit resolution. We're back to talking about high inflation, though. We're also counting down to the US jobs report. That's due at 8:30 a.m. Eastern Time. Former Fed Governor Randy Kroszner joins our special coverage before and after that report hits the Bloomberg terminal. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
So far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jake Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May jobs report, today on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, one of the big questions about this rally is whether or not it's sustainable. And the core of that question is, if it's sustainable, why are we seeing such narrow breadth? Is this one of those times where the exception may actually apply? And I want to bring a chart to your attention. For our radio audience, stick with me here. We are essentially looking at kind of sector performance in the S&P 500 and what has led to the rally. And we're looking all the way to the right side of this chart, which shows, again, extremely narrow breadth. we are seeing green on the screen, but it's only led by a handful of companies. And that's really different than what we've seen going back about the last 10 years or so. We don't see this kind of narrow breadth often matched with these kinds of gains. But I have to say, there's an argument that says, look, there is real money entering the technology space, the AI space. So perhaps that rule of breadth equaling sustainability doesn't necessarily matter for the bull market. That may or may not be true. Let's bring in a true expert, Denitsa Sakova, our Bloomberg cross-asset reporter. What's your take on the story? Is breadth needed for a sustainable rally?
Yeah, of course, like we can see a very narrow breadth all over the sectors. We can see it if we compare growth and value. There has been incredible outperformance of growth drawn by quite a few stocks. You can see it in the S&P 500. If we compare equal weighted, that kind of removes the value bias versus the original S&P. And then the gaps also a record. We're seeing the widest gaps in 30 years. Whether this is sustainable, of course, a big part of it is IE optimism, but we have to remember that also we had better than expected earnings that lifted sentiment. We also had a bias, defensive bias, and investors fleeing to safety, and some of those companies have strong balance sheets, so that's a big factor. And I think we're seeing is there are big inflows into stocks this week. Latest data by EPFR shows. So there is actually money coming into that rally. How far it will go, of course, there are a lot of factors, economy, Fed, so it's too early to say. But there is some belief in investors that this might be a good time, at least the last week, to put some money back into stocks.
Okay, so that's interesting on the breadth of what we're seeing. In terms of where the excitement comes from in technology, clearly AI, it was such a buzzword for a long time, and then we saw some actual bottom line impact of it from the likes of NVIDIA. This has created, obviously, a lot of buzz, but you say that some of the active managers didn't see this coming. What's the story there?
Yeah, for sure. So active managers were actually quite underweight technology stocks, so they missed a lot of the rally, and some people are attributing part of the rally because a lot of people there was a heavy activity in calls, so a lot of people were kind of chasing the rally and trying to catch up on this AI hype for the last week. So that was, that was also supporting markets, but we're actually seeing some flows of people buying this week, along with active manager catching up on what maybe they've missed in the last few weeks.
What's the overall mood in markets like then, Denitsa, as we seem to have put to bed the concerns around the debt market, the debt ceiling, sorry, in the US? We wait to see what exactly that means for the Treasury, for issuance, for corporates, and for governments. And then, of course, we're moving into the jobs report, so very quickly we'll be into digesting what all of that means for the Fed in the month of June. What's the overall mood?
Yeah, so if we look at, for example, the VIX or the zero-day options, markets are quite calm. VIX is below 16, which is really calm. Going into a jobs day, the zero-day options is actually the quietest we've seen it in a year. Generally, positioning is neutral. There hasn't been, there hasn't been big buying or selling in the last few weeks. Of course, we have that big jobs report coming today. We have inflation data coming on June 13th. So there are so many things that can change. Of course, we haven't seen a big rally after the debt ceiling. There are a lot of issues about liquidity, what happens after this big T-bill deluge that we're probably going to see next week. So, we've seen improvement in sentiment, but we haven't seen any actual actions because investors are perhaps liking for all those potential headwinds to maybe pass by.
Denitsa, thank you very much. Denitsa Sakova joining us there from the cross-asset team with a look at the markets. For more market analysis, you can find the Markets Live blog at MLIV Go. That's the function to use on the Bloomberg terminal. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Now keeping you up to date with news from around the world, here's the first word. Ukraine's air defense says 15 cruise missiles and at least 21 drones were shot down in the Kyiv region today. Ukraine's capital has been attacked by Russia from the air on each of the past 6 nights. No casualties were immediately reported after at least 3 people, including a child, were killed in Thursday's barrage. Meanwhile, drone attacks have been reported across a widening swath of Russia. Bloomberg has learned Turkish President Recep Tayyip Erdogan will tap Mehmet Şimşek as his new Treasury and Finance Minister. Şimşek is an advocate of conventional economics. Supporters say his appointment will likely shore up market confidence. Şimşek is set to be in charge of all of Turkey's economic policies in the new cabinet. Erdogan won re-election on Sunday, extending his more than 2 decades in power. Jamie Dimon will visit Taiwan after wrapping up his high-profile trip to China. The stop-off by the JP Morgan CEO comes at a time of heightened tensions between Beijing and Washington. LVMH CEO Bernard Arnault, meanwhile, has become the latest big company boss to announce plans to visit China as Tesla CEO Elon Musk returns from his whirlwind tour of the country. Goldman Sachs is warning of a sharp slowdown in its investment bank compared to the bumper gains a year ago. Its president, John Waldron, says the trading business is trending down more than 25% this quarter. Goldman is working on what would be its 3rd round of job cuts in under a year. A lot of movement in the financial industry, Anna, from job cuts to diversifying regionally. You can really see a lot of the big players on global Wall Street really starting to feel the pinch.
Yeah, a lot of interesting themes going on there. Interesting, you mentioned Jamie Dimon's trip to Taiwan, and we understand other leaders of US businesses have made that visit. The boss of NVIDIA, very newsworthy these days, he was there not all that long ago. I was taken by that Goldman Sachs story, though, because there's a contrast there, Chrissy, between what they were saying about the environment they see and Bank of America saying that for them, the quarter appears to be flat-ish when it comes to those same markets. So we'll continue to watch the investment banking story, the FICC story, the equities trading story, and see how these trends develop through the quarter. Coming up on the program, we'll get back to the macro markets. Elliot Hentoff joins us, head of macro policy research at State Street Global Advisors. That conversation next. This is Bloomberg.
lives.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more, but
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Crisis averted. The debt ceiling bill clears the Senate, removing the risk of a U.S. default. The measure now goes to President Biden for his signature. Attention turning to today's U.S. jobs report. The data may show a slowdown in the pace of hiring that could potentially allow the Fed to pause its tightening policy in June. And Broadcom predicts that sales tied to AI will double this year, though the chipmaker remains mired in a broader slowdown. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot to digest there. We're kind of reverting back to those old concerns, inflation, growth. I wonder which takes the cake in today's data.
Yeah, absolutely. We'll certainly be focused on the labour market later in terms of data, won't we, Kriti, and what that means for the inflation story. More on that labour market dynamic in a moment. Let's have a look at where we are on the European equity market story then, up by just over 1%. Relief at the passing of that debt deal through not just the House, but the Senate. Also a little excitement, perhaps, about the Chinese coming in to support the property market. That headline at the top of the hour, perhaps lending some extra support to European stocks. And that market, the European market, sorry, certainly doing pretty well this Friday. The Turkish stock market doing well. As we understand, according to our colleagues reporting in Istanbul, that we might see the return of somebody who used to be Deputy Prime Minister coming back into the Finance Ministry over in Turkey under President Erdogan. But if Mehmet Semsek does come back, he's a known quantity to market, somebody with quite conventional views, former Wall Street banker, so somebody who the market knows and understands, and that is putting some positive momentum under Turkish stocks today. This is SBB, that long name we usually shorten to SBB, the property business over in Scandinavia, in Sweden. And we understand that Brookfield could be interested in coming in and buying up this business or buying parts of the portfolio of this property management company. And so the stock is up by 28.4%. Early stages, those talks, but talks have been taking place in London, we understand. Dechra Pharmaceuticals, a pharma business, Kriti, but not for you and I, it's for pets. But this has been the subject of a takeover approach from EQT. And as a result, that stock up by 8.4%.
I love that you mentioned the pets. Harvey, my puppy, will be very happy to hear that development. Anna, the stateside story is pretty similar to what you're hearing in Europe, especially when it comes to sentiment. Remember, the China story is absolutely playing a role when it comes to the state story. Remember, after the global financial crisis, part of that global recovery was this massive investment and stimulus from China. So really kind of incorporating that Chinese growth story, the idea that the Chinese Communist Party and the central government might actually be able to prop up up. The Chinese growth story is a positive, even for S&P futures, which have been ticking higher, similar to what you're seeing in the European session, to the tune of about higher by 0.5%. But I got to say, when it comes to the bond market and the FX market, it's likely to be all about that payrolls report that we are going to get in just about 3 hours. The 2-year yield at about 4.34, hovering over there in a little bit of a wait-and-see approach, because that payrolls data, Anna, is going to change the game when it comes to market pricing of whether or not June is a pause, a skip, or potentially another hike. That's really the data point that we are waiting for, and likely going to lead the story for the dollar as well, seeing some weakness in the greenback, down about 0.2% in the opposite direction to the yield story, which is interesting. The ripple effect of that is going to be a little bit of a tailwind to the commodity space, despite those growth concerns that we are talking about. NYMEX crude trading at a 71 handle, higher by almost 2%, also likely trading off, Anna, that Chinese story that we were talking about.
Okay, let's get to a macro conversation. Elliot Hentoff joins us, Head of Macro Policy Research at State Street Global Advisors. Elliot, really nice to speak to you this Friday, and the perfect voice to have on the day the day after we've seen the debt deal pass through the Senate. So we're a little more certain that is going to be an issue avoided, no US default. But what does that mean for Treasury markets? Because for some time now, we've seen this sort of dislocation at the short end of the Treasury curve because of concerns around the debt ceiling. Now that's resolved. Now the Treasury goes out and issues, and investors pile back into that period. So what is that going to do to liquidity in the markets and to broader market themes?
Well, the first thing that we could track is that on our behavioral risk scorecard for institutional investors, we've seen a slight kind of comeback in terms of risk appetite. So clearly the resolution of the debt ceiling issue has been positive for markets. Now, with regards to treasuries, there's obviously a massive issuance that's going to happen. That was always going to be the case, regardless of when the debt ceiling would be resolved. The mechanics of that are that there's a net withdrawal of liquidity from the market. The question is, where does it come from? And that matters a lot. Does it come from bank reserves and basically further kind of inhibits and shrinks the banking sector's ability to lend and extend credit? Well, that would be quite negative for macro. Or does it come kind of from reserve repo facility where money's just sitting and being parked at the Fed anyhow? Then the macro impact is a little bit less. But nonetheless, it's a net liquidity withdrawal. And the important thing to remember is that in the first half of this year, the Treasury just depleted its cash pile. So some of the GDP figures are a little bit flattered by the fact that we basically had cash of the tune of 2% of GDP that was basically at no cost. It didn't have to be borrowed. It didn't have to be financed. It just was depleted.
Could it come from other parts of the bond market? Is that a possibility? I mean, where do you think it's going to come from? What impact do you think it's going to have then, Elliot?
I think it'll be a mix of all. Some of it will come from abroad, or it'll be foreign investors that actually decide to leave more money in the US market than expected. So that in the short term is supportive of the dollar. But by and large, we think it's a mix. I think the more optimistic view is that a lot of it will come it'll just wander off from the repo facility at the Fed and off into the Treasury bill market. But that's a benign view. No matter what, net, it's a negative. The question is, what's the magnitude?
So, Elliot, that is the U.S. story. Let's talk about the China story here, because it starts to feel like the narrative, in the absence of kind of the debt drama, has really shifted to the growth story. How crucial or how underpriced is the China story right now when you're looking at European and U.S. markets?
Yeah, I'm a bit puzzled by this whole discussion around the disappointing macro data from China. The day China reopened in December, we had a forecast of GDP growth of around 5% for 2023. And 6 months later, we're happy with our forecast. It's unchanged. We think we're on track. We actually think the normalization is proceeding roughly along the lines of expectations. Our view was a little bit below market, and I think perhaps the markets got a little bit too excited that you'd have this highly accelerated reopening process, the way you had it in Western Europe and the US. Obviously, China was always going to be a little bit different. Property is a structural weakness, so trend growth for years to come will be lower in China. But I think the important thing to remember is that this is just a slower process, so it may last a little bit longer. We have kind of 4.7% growth penciled in for next year. Again, lower than pre-COVID, but these are decent numbers. We're kind of still confident on the China story.
You're certainly in the camp of the growth is growth at the end of the day. A fair argument to be had. Elliot, what we love to have you on the show for is your kind of marriage of both policy and the markets. Talk to us a little bit about whether or not this market should be even concerned about the geopolitics at play, because even though it does feel like Beijing and Washington, for example, are perhaps at heads, you are seeing these headlines that Elon Musk, Bernard Arnault, Jamie Dimon, you name it, they are making trips to both China and Taiwan, excuse me. What do you make of that? How does that kind of compare and contrast with what you're hearing from your clients?
Yeah, it's a bit paradoxical because in the near term, our advice has been to ignore geopolitics. It's not market relevant, probably for the most of this year. We're much more worried about next year, where you actually have a variety of event risk that comes back. One is probably some type of peace process on the Ukraine war, where China's role is pivotal, and there's this negative spillovers potential. There's the Taiwan presidential election, the US presidential election. So we're worried about next year, but for the coming months, it's clear China's prioritizing normalization of the economy. The US is trying to put in guardrails in terms of the US-China relationship, and therefore it's not really a market story for the coming months. It will return in a big way because the long-term trajectory is clear. Greater risk, greater spillovers into markets in a negative way.
We started this conversation talking about the US, and I'll pivot back there, if I can, around the Fed thinking at the moment. Elliot, what is your thinking around June? Are you buying into this idea that we get a skip? It's a new word for a pause, apparently, but it means you go back to hiking afterwards. What's the thinking for you?
Skips are very unusual in central banking. It's just not what central bankers typically do. We've only had one Fed hiking cycle ever where the skip became kind of a habit, and that was the last one in 2015. That's when deflation risk was kind of pronounced post-financial crisis and otherwise. The reality, a skip is actually rather unlikely. You know, if there is that pause, it probably means that we hit peak Fed. Again, back to the Treasury bill issuance, you're going to have some liquidity conditions deteriorate over the summer. So it's hard to make the case that why would you hike in July when kind of a lot of the liquidity headwinds make themselves felt when you're not doing it in June?
Okay, Elliot, thanks very much. Thanks for joining us. Good to speak to you today. Elliot Hentoff of State Street Global Advisors. Coming up on the program, riding the AI wave, we will hear from the CEO of the software developer C3 AI and take a look at the growing interest in AI-powered avatars. This is Bloomberg.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Let's turn back to the AI frenzy that's been fueling the tech sector. One of the biggest players in this space is software developer C3 AI. The company CEO spoke on Bloomberg yesterday. He says the AI rally, it's not overdone.
Well, looking at the big picture, when you see the people who are making the semiconductors that are running these AI applications announce that they're increasing, almost doubling production. In the case of NVIDIA, I think from $7 billion in chips to $11 billion in chips in 1 quarter. I mean, this is unprecedented, I think, in the history of the semiconductor industry. And so I think that's proof positive that this AI phenomenon is very real, just in the amount of CPU consumption that we're utilizing.
Well, let's talk about your company specifically and your earnings. Your revenue forecasts were seen as disappointing, but you note in your own earnings as well that you've got a limited list of clients, in particular a reliance on deals in the energy space, companies that use your software to analyze huge amounts of data. Outside of energy and defense companies, who are you getting calls from right now?
Well, if we look at our the industries in which we did business last year, we did about 33% in oil and gas, almost 29% in defense and intelligence, 13% in high tech, 11% in energy utilities, 5% in each in manufacturing, food processing, chemicals, life sciences. So it's getting increasingly diverse.
That was the CEO of the software developer C3 AI. Let's stick with the AI theme. As the generative AI frenzy continues to ramp up, its applications in media, e-learning, and communications are drawing new interest. The digital avatars market is growing fast and is expected to top $525 billion by the end of the decade. Tom McKenzie, our colleague here at Bloomberg, spoke about this with his, yes, this is real, very own digital twin.
They can revolutionize industries such as entertainment, gaming, and virtual communication. Avatars have the power to enhance user experiences, enabling immersive virtual interactions and personalized content. They can facilitate remote collaboration, telepresence, and even assist with customer service.
Well, this just got a whole lot of weird, because that was Tom talking to Tom, and Tom just joins us now here in London on set. This is the real Tom, the Tom McKenzie that I prefer, as opposed to the slightly stilted avatar version. Tom, tell us about the process then of creating an AI-powered avatar and then talking to yourself.
So there's obviously a lot of threads to the AI story, and one area that we wanted to explore and understand better, partly for self-interest reasons, is digital avatars and digital twins. So we worked with a company called Synthesia. They're at the leading edge of generating these digital avatars. We went into a studio in East London. I recorded some voice tracks, a lot of voice tracks. Some of the language were very strange, and stood in front of the camera and did some movements, because, of course, they want to be able to put all of that data into their AI-powered algorithm to build out this avatar. It took a bit of time to process all of it, but the deal is, once you've got this avatar, you can get it to basically say whatever you want it to say to. We use ChatGPT for these answers. So we went to ChatGPT, asked some questions to ChatGPT, we took that text, put it in the avatar, and those are the responses that you're hearing. So that's a bit of the background behind how we produce this.
Put some numbers on it for us, Tom. I mean, that looks like a lot of fun, but why would someone actively invest in this?
Yeah, so the business case is this, and Synthesia, they work with about 15,000 clients, they say, including the likes of WPP, Ocado, McDonald's, Amazon. And the case that they have is a lot of this is used for internal communications for some of these big companies. So you can imagine the CEO or an executive, he or she wants to put out a message across their global teams. They generate and build out an avatar, and then they can get the avatar of themselves to generate and deliver that message, whether it's in Spain or China or back in the US, because they have about 120 different languages that they can program around this. Top line, according to some research, this could be an industry, this could be a particular sector, digital avatars, worth about $530 billion just by 2030. What Synthesia says, it reduces the cost. You don't have to spend all that money on camera teams and audio and all the rest of it, editing. You do it once, costs about $1,000, and then you can reuse your own avatar for delivering those internal comms messages. But you can imagine that the door is open now to much wider use as well.
Yeah, I mean, I can see the attraction, but you also have to wonder how the message lands, I suppose. If you don't send the CEO, you send the CEO's avatar. I wonder how the messaging comes across. What are some of the ethical concerns then and the risks surrounding this?
Well, they're numerous. They are numerous. And, you know, look, I actually put that question to my own digital twin, my own avatar, on the risks, some of the ethical concerns. So take a listen to what I or it had to say.
Ethical concerns arise, including issues related to bias and fairness in AI algorithms, transparency and explainability of AI decision-making, data privacy and security, and the potential for AI to perpetuate existing social inequalities.
Okay, so some examples there given by my own digital twin about some of the risks. Talking about generative AI in general and across the board, in terms of the concerns about data quality, whether it embeds biases, gender biases, race biases, the question of fairness, the fact that ChatGPT and other platforms sometimes produce what are called illusions or hallucinations. Basically, they get things wrong.
Yeah.
When it comes to these digital avatars, concerns about deep fakes. So you could get a digital avatar of the president of the US, for example, delivering a message that he or she wouldn't be delivering. So that's a concern. And then a replacement of jobs. And I actually asked myself whether we were going to be replaced. And they said, don't worry, TV anchors are safe.
Okay.
Because we have charisma. So that's clearly true for you, Anna,
Amazing.
and Kriti. There's still a big question mark over me, I think.
Well, I still prefer the real Tom to the digital one,
Well, thank
so I
you.
think we're safe. I think we're safe there. Tom McKenzie, thank you very much. Tom McKenzie with the latest on those slightly surreal AI developments, talking to himself. Now, coming up, the countdown to the US jobs report. More on that. And what we expect, we will talk to, who else? Mike McKee. He brings the charisma. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, we get the U.S. jobs report today in just a few hours, 8:30 a.m. Eastern time. The data could show a slowdown in the pace of hiring. Joining us now is Michael McKee, Bloomberg International Economics and Policy Correspondent. Well, could show the slowdown, and that's the hope that it's going to from the markets. Are we going to get there?
Well, it's all relative, of course, because when we're talking about 195,000 jobs is the forecast, that is still a significant number, and it is far above the number that economists say you need to fill the replacements, all the people who come into the labor force each month. So we'll see whether we go down or not. Unemployment expected to tick up just a little bit, and we are going to be watching average hourly earnings because the Fed's going to be watching average hourly earnings. But I tell you, Crady, if you're a momentum trader and you had 13 up days in a row on a stock, you might want to buy into it.
Yeah.
We've had 13 up months on non-farm payrolls. For 13 months in a row, payrolls have come in higher than the Bloomberg consensus. And so maybe you want to think that is a good bet today. The whisper number on Wall Street, according to Bloomberg's whisper function, is 226. So Wall Street leaning towards the idea that we're going to get a 14th month in a row.
Okay. WIS go, I think, WHIS, isn't it? The function to find those, Mike. Yeah, incredible run then for that payrolls number. How much weakness do we need to see in the jobs market? Not that anybody in an abstract sense wants to see weakness, but how much will we need to see, or is the Fed thinking we need to see to weigh down on inflation?
Well, they'd like to see the unemployment rate start to rise, and suggesting that the labor market is cooling, and at the same time you might see average hourly earnings grow a little bit more slowly, and that's their goal. We're running at a 4.4% average rate each month, annual average, and they'd like to get that down to 3 to 3.5%. But the numbers that have been coming in lately have just shown us very strong labor market remains. We had that JOLTS report that the Fed relies on come in over 10 million again. And of course, ADP this week, even the ISM manufacturing numbers came in stronger than expected for employment. So it looks like the odds are still stacked against the Fed getting what it wants out of the labor market.
Which brings us to the whole concept of a pause, a skip, a gallop, if you will, from the Federal Reserve. Is this one data point really going to make a difference? Doesn't Chairman Powell love to say, look, we are not data, or we are data dependent, and one data point isn't enough to make a call?
Well, the speakers that we have heard from lately, including the presumptive vice chair, he hasn't been confirmed yet, Philip Jefferson, suggest that this data point isn't going to matter, that they still think that they can do at least a skip, not raise in June, and then maybe do it in July if they need to. But if it comes in very strong, especially if wages start to rise, then that could push against that idea. And then, of course, we get the CPI the day before the Fed decision. So today's number and the CPI number will tell us what the Fed is likely to do.
Certainly a lot to digest, and going to be the major macro market mover this morning. Michael McKee, our international economics and policy correspondent, we thank you as always. So that's the macro. Let's look at the micro here. We are watching a few of these stocks in the pre-market. Remember, earnings season still kind of trickling out. Lululemon at the top of that story, higher by about 15% in the pre-market. Their earnings beating estimates. That higher income consumer still buying athleisure, and that is really feeding into their bottom line. So that is good news over at that company. But from retail, let's go to the tech sector. MongoDB, for example, surging on that boost in their EPS forecast. Again, a major tech name here, higher by about 26%, and you are seeing them actually beat their estimates as well. Broadcom is going to be a really interesting story, though, especially when we're talking about this wider slowdown. Those gains, though, overshadowed by the sales slowdown that you're seeing, despite them actually coming out with some good numbers. The share's taking a hit, down about 2%. Anna, and then, of course, Dell Technologies, one of those old guard tech names. Those results are suggesting perhaps there's a bottom in PC sales, but they're not seeing that momentum, that business investment that you would expect. Those shares, again, down just about 3.7% in the pre-market. So a little bit of pain in a little bit of sectors.
Yeah, it's really interesting to watch how this the AI boom is spreading and perhaps limited in some parts of the tech world. So some areas of tech benefiting from it, and others, yes, benefiting, but also feeling the headwinds from the broader tech, broader chip story that we're seeing globally around Chinese growth, perhaps. Now, that is it for Early Edition then, Chrissy. Surveillance is, of course, ahead. They'll be speaking with Nadia Lovell of UBS, Randy Krosner of the University of Chicago, and Jeff Rosenberg of BlackRock, all joining the team. Lots to discuss as the team gets you ready for that jobs report. Look for that coming a little bit later on today. They'll get you through those numbers and be considering what all of the data means for the Fed, of course. This is Bloomberg.
middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The economy really hasn't slowed much at all. We had the Q1 earnings results. Corporate America is actually doing all right.
This is a recession postponed, not canceled.
Even if we have a mild recession, I would still cast that as potentially a soft landing sort of scenario.
We've learned that you have to be cautious. I think we've learned that you have to be tactical in this market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Payrolls Friday, live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive by 0.5%. We'll get to the payrolls talk in just a moment. Your expectation in our survey, 195,000. Before we get there, TK, it's been your story of the week. It's China. The latest reporting from our team here at Bloomberg, according to people familiar with the matter, China is working on a new basket of measures to support the property market.
Right.
TK, that's where the push will be, potentially.
Out early, this is Bloomberg. Bloomberg's reporting this from across our offices in China, that there already is a plan here on property. That's where you go when you're worried about the people and investment in China. It doesn't say much about job formation and the other worries. It moves renminbi right away. Bloomberg put out the story. We get a stronger renminbi coming off of a 7.11 out to right now 7.06 on renminbi. And, you know, we got to get, I'm going to get John to our Sunday evening, their Monday morning. That's when the news breaks.
Property developers anticipating this rallying overnight. The Chinese equity market had a better time of it. And we need to be clear about things right now. Three engines of global growth. China sputtering, Europe struggling relative to some pretty lofty expectations coming into the year, and US resilience. You look at the labor market data so far this week, claims still exceptionally low. Vacancies at American employers much higher. The ADP report knocking it out of the park. And Tom, we'll see if we get more of the same in 2 hours, 30
minutes.
We're
deep into the month of June, and there is this new idea. I think all of May was about American exceptionalism. Lisa, I think, was talking this up correctly. And our first guest today will talk about what really happens in recession, which is, do you, OMG, we're all going to die at once? No, you roll through a recession, and maybe that's what we're doing now. Parts of America in this jobs report today flat on their back.
Oh, without a doubt. And let's be clear about that as well.
Macy's,
I think it's so important. Dollar General, Macy's, there are others out there as well. It's been a week of contradictions because you compare the fact that we've got some really resilient, robust labor market data, with some manufacturing data, Bramo, which was absolutely terrible.
Bramo's here on a Friday.
Is that what you wanted to interject with?
Jobs day, yeah.
I will just say this, that when you take a look, I'm not sure where we're going with that, but I will say this. When we take a look at the manufacturing recession and then the resilience in consumer spending, you start to wonder how much is the U.S. different not only because of tech, but because of a stimulus, because of helicopter money that hasn't worked its way through the system? And at what point are the different whims of the post-pandemic reality and the norms of perhaps YOLO and traveling and going out to eat, when does that sort of, expire and start to create something that's more consistent?
To the celebration in Washington, is Anne Marie with us today? I don't even know.
She will be, yeah.
And the Senate vote and all that, we're maybe less austere than they are. And John, you lived this for your entire life in London. There's a whole idea in the United Kingdom of austerity, and maybe there's a different French austerity or China austerity, and the U.S. says, let's do the Biden stimulus.
It's all relative. I think we've all just been surprised by the resilience story in the United States. Let's get to the price action. A lift in the equity market. Equity futures on the S&P 500 doing better, up by almost 0.5%. Yields a little bit higher as well, up by a single basis point, 361. When you hear a sentence that says China stimulus somewhere in it, usually you look to commodities, and crude is higher this morning, Lisa. 71 on WTI.
I do wonder, though, how much more could be following with stimulus. We'll be talking about that probably throughout the day. The key data point of the day, 8:30 a.m., May jobs report. There have been 13 straight months of upside surprises. I just want to point that out ahead of a report that is expected to be softer, and yet, the unemployment rate ticking up from 3.4% to 3.5%. Get ready for pearl clutching. Not going to necessarily change the dial all that much. Nevertheless, interesting to see, particularly under the hood dynamics. Today, JP Morgan COO Daniel Pinto and Citi CEO Jane Fraser among speakers at today's Bernstein conference. This comes after yesterday's Goldman Sachs comments about trading being down about 20% and more job cuts, talking about a difficult scenario. Curious to hear whether they're the same kinds of discussions.
I'm really glad you brought this up. There was a change in tone this week. I talked to Srinath Rajan about this on Goldman Sachs and Bloomberg reporting that there's just a shift in tone.
And talking about how some of their clients are much more pessimistic than they had been previously. I'm watching for that. And this weekend, the OPEC Plus meeting begins in Vienna on Saturday, continues to Sunday. Very curious to see what kind of relationship there is between the United Arab Emirates, Saudi Arabia, how they pair those ideas, how they impose more cuts at a time when a lot of people are lobbying to produce
John,
more.
we should be there.
If the press aren't there, did it happen?
Yeah.
Are we reporting on this?
Well, yes.
Javier said no, we're not.
My understanding is Bloomberg reporters will be in Vienna, perhaps not in the room. I'm sure they will be talking to everybody in the room.
Okay.
But how do you cover something where they aggressively do not want you to cover it, want to massage the message? It's going to be an existential question for journalists.
That cartel is like the leakiest thing in the world.
Yes.
Seriously, even if you say journalists out
No
loud,
pun
isn't it?
intended.
I mean, you speak to people who attend that conference, that get-together, that meeting, whatever you want to call it. It is the leakiest thing ever.
The whole purpose is to message something, right? It's to basically jawbone prices into a certain direction and give some sort of appearance of unity. So it is all about the message. Of course, it's going to be leaky with people trying to lobby for their message to get
On
out.
a microeconomic basis, a cartel is nothing but jawboning. I mean, by definition, that's what a cartel is. It's a verbal statement that doesn't have any reality in economics. I mean,
some people just want to be heard, though, Bramo. It's not just about trying to manage prices. It's about ego. I'd like to be in touch with journalists. But, you know, people like that, some people are like that.
Yeah.
That's why you get those leaks. Some people like to talk to journalists. They just like to be heard.
Yeah, John
like an
walks in-
audience.
Well, if anyone wants to be heard, this is going to be a public service announcement. Feel free to give a call.
Steve Whiting joins us now, Chief Investment Strategist and Chief Economist over at Citi Global Wealth. If they scroll a little bit, there we go. Steve, I'd forgotten your title. It's great to have you with us, Steve. Let's just start with Fed policy. Coming up a little bit later, we get payrolls. If we de-emphasize the importance of payrolls a little bit later, given the guidance we've had from Fed officials earlier this week?
Perhaps not. I mean, there's been so much other news to consider. When you think about the Fed, they've done an average of 50 basis points for 10 consecutive meetings. Now, by the time inflation is down exactly to where they want, and their price measure, the one that doesn't move as much, the PCE deflator, could be another 10 meetings. But they can't go on tightening 50 basis points every single meeting without getting a policy that would ultimately crash the economy. So they've set us up here, particularly while we were having all of this debt ceiling uncertainty, which we couldn't ever be certain what the market effects would be, what the effects in Washington would be, to at least skip a meeting and just see. But now we run into the payrolls data. And again, it could make it a little difficult, again, if it's a big surprise one way or the other.
Steve, you bring prodigious economics to the strategy part of the game. I love in your research note, you talk about a rolling recession. is a general statement, and I'm thinking NBER, but it can be as a general statement as well. Are we going to have a rolling recession that will actually affect the glory sectors like technology? Can we have a recession that rolls to NVIDIA?
Well, look, it's different every time in terms of composition. If this was, the year 2000 into 2021, then the answer would be yes. But I would probably say no in this case. I think that you're going to see growth in AI has been really constrained entirely to building the infrastructure of AI. Now, whether that's gone too far in a particular stock or not is one thing, but I think it'll broaden out its impact in coming years. And it's really not at the heart of what's going on in any of the slower sectors of the economy. You said it just before. The ISM data shows that manufacturing and trade around the world is contracting. It's in recession. Some industries didn't quite have the downturn or the upturn like autos. The multifamily apartment sector is something that I think everybody should be looking at and saying their recession hasn't happened yet, but it's coming. It'll be like single family housing, which is already having, in some respects, a bottoming in sales. Declines are already happening in production. It's allowing us, while we still have strengthened services from these COVID distortions that you just spoke about, it's allowing us to actually work off inventories. So the rolling recessions are having the intended effect. It's holding the American economy's growth rate down, but it's not crashing it. And in fact, I think that's what we're seeing around the world, of more or less listless growth rather than a collapse.
Did you see anything during the first 6 months of this year that made you materially change your allocation heading into the second half?
Well, we did some things, to be quite contrary in some respects. Defensive investments, really, again, you can do this in any asset class. For example, we were overweight pharmaceuticals. They fell 2% last year. Global equities down about 20%. We still love the industry. We don't think that it's overvalued, but we got about as much defense as we could out of that. So what we did is we reallocated to some more offensive investments. These are around the world. You could take a look at Brazilian equities, or 7 times earnings, 7% dividend yield, 9% real interest rates as inflation is coming down. So a currency that's very weak. You can see, again, how China may not be the only source of growth in Asia. You can broaden this out. So we've allocated about 4% more to non-U.S. equities. And I would say that, again, there's more to do here. We're actually seeing the dislocations of a recession in some parts of our equity markets. So, again, we're not exactly bullish. We're underweight equities. But a lot of things that actually occur in recessions that clear the decks are, in fact, happening.
Certainly seeing that in manufacturing right now. Steve, thank you, sir. Steve Whiting there of Citi. If you take a look at the ISM manufacturing that came out yesterday, below 50, you've got this dividing line between expansion and contraction. That line is 50. We've been below 50 for 7 consecutive months. That's the longest streak, Tom, going back to, guess when, 2009.
Yeah,
2009. It's pretty terrible, the read on manufacturing right now.
On a Friday, this is really important as we all read into the weekend to recalibrate for June. And part of this is this bifurcation in China, in the U.S., maybe in Europe as well, between manufacturing and a consumer service sector, almost financial restaurant boom that's in there. John, I think we've got to reframe in the jobs report here the excitement in the equity market. I didn't realize this. The VIX, 15.45, I'm sure off the enthusiasm in Washington. John, 5:10 a.m. today. This is before I got in. Round up the Standard & Poor's 500 to 4,300. We went over 4,250 on futures. So, I think any optimist would round it up. 4,300 coming.
Ultimate contrarian trade right now. Michael Hartnett, Bank of America. Buy the Hang Seng, sell AI on surprise June China stimulus, bullish commodities, EM, resources, and banks. We'll pick up on that note a little bit later. Equities right now up 0.5%. From New York on this Payrolls Friday, your estimate 195,000, your number, about 2 hours and 18 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo.
Global food costs fell in May, dropping to the lowest level in 2 years and reviving hopes that inflation on supermarket shelves will start to ease. The United Nations Index of Food Commodity Prices fell 2.6 in May as declines in grains, vegetable oil, and dairy offset gains in sugar and meat costs. The gauge of prices for internationally traded agricultural commodities has fallen 22% from its peak last year following Russia's invasion of Ukraine. In Singapore, Pentagon Chief Lloyd Austin and his Chinese counterpart Li Shangfu are among more than 600 military leaders, policymakers, and analysts from 40 nations taking part in the annual Shangri-La Dialogue. The U.S. says Beijing has ruled out a meeting between the two military chiefs, with China frustrated the Biden administration hasn't removed sanctions the U.S. placed on Li in 2018. The Pentagon is set to buy Starlink satellite communications terminals and services from Elon Musk's SpaceX for use by the Ukrainian military. The U.S. has praised the role that the terminals have played in Kyiv's war effort, seeing them as vital for the country's defense. And Rishi Sunak's administration has refused a demand from the UK's COVID-19 inquiry to hand over former Prime Minister Boris Johnson's WhatsApp messages and pandemic diaries. The government's cabinet office says it's filing for a judicial review into the request for the documents. The move sets up a legal battle that risks amplifying accusations of a cover-up. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Was going to keep rate World Cup. This is a 3
as the economic picture does.
The UK is getting ready to make.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. So far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jake Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May jobs report, today on Bloomberg Television and Radio.
This demanded a bipartisan solution. We knew we'd need to come together for a solution like the one that passed tonight. And so I'm happy to stand here passing this critical legislation to support our families, preserve vital programs, and most importantly, avoid catastrophic default.
63 to 36, Senate Majority Leader Chuck Schumer, the debt ceiling bill passing the Senate with ease. It's onto the president's desk. This is what the president had to say. No one gets everything they want in a negotiation, but make no mistake, this bipartisan agreement is a big win for our economy and the American people. I believe we'll hear from the President of the United States a little bit later on this evening, Tom, when he addresses the nation.
It's gonna be interesting. Of course, he had this fall yesterday at the Air Force Academy. I watched the video carefully, and he made a joke about it. He got sandbagged. He did. It was sitting there, just like on a stage. I think I saw Francine at Chernobyl fall over a sandbag once, and it's the same thing. These little things are down there on the floor, and they can bite you.
Except it's not the same thing, because this individual is 80 years old, and every time we see any kind of incident like this, a lot of people, Tom, are going to be saying the same thing.
I was the same way.
Yeah.
Absolutely, no question about it. You're waking up to, can we say crisis over? Is this the first morning?
Unless the president surprises us and says, no, I'm not signing it. No, I think we can say crisis is over.
Let us recalibrate on a Friday and move forward, and we're going to try to avoid the silliness of the political season. You can do that with Daniel Clifton. To say he's partnered head of policy research at Strategas doesn't describe that when he started writing notes years ago, they came out of the screen, came off the internet with terse facts about what's going on. The fact that has changed, Dan Clifton, is the guy from Bakersfield. Here's a kid out of Bakersfield. He was a firefighter. He worked his way through one of the Cal State systems. Kevin McCarthy's been underestimated by everybody from day one. You write this morning on the underestimation of the speaker. How big a victory is it for Kevin McCarthy?
Well, it's big. It's not the biggest. He still has problems in his caucus, but this is big. He earned his speakership over the last 3 months. This was a president who said, I will not negotiate on the debt ceiling. I believe the president was very clear about that based on his own experiences, which you remember very clearly, Tom, from 2011 when he was vice president. And the speaker unified his caucus, passed a bill out of the House of Representatives, forced a negotiation, and got $1 trillion of spending cuts. Did they get everything they wanted? Absolutely not. And that's evident by the vote totals that Jonathan just reported on. More Democrats voted for the debt ceiling bill in the House and Senate than Republicans did. But this could have gone far worse. The brinksmanship could have been far more intense if McCarthy wasn't able to unify his caucus the way he did. And he delivered 2/3 of Republicans in support of raising the debt ceiling. It's a big, big win. And he showed that he can do this better than previous speakers.
To stagger forward to November 2024, is the middle changed? I mean, obviously there's going to be a polarity primary on both sides, but did the respect for the middle change within our political class?
No, I think that we always have a middle. It's just the extremes tend to amplify that. Let me give you one example. We've had 9 federal elections since the financial crisis. And the voters of this country have removed the party in power in 8 of those 9 elections. So that's somebody in the middle moving between both sides back and forth. And I do think that that middle does hold. It's just a really ugly process here. The process of getting legislation passed, but it got done on a bipartisan basis, and how we select our presidents moving forward. And so I think this is going to be the wildest election of our lifetime. It's going to make 2016 and 2008, which were just classic, amazing elections, be very, very different this time. But we have a lot of challenges, Tom, before we get there. We're going to have to settle how we're going to do the defense spending budget, even though we have a top line spending number. We're going to have to figure out how we're going to respond to China with these new budget limits in place. And the Treasury is going to be very, very constrained in how they are raising the debt with the rising debt service cost in the first 35 years. So it's easy to pull forward and say, okay, we got this big crisis out of the way. What's going to happen in 24? But we're going to have some serious domestic and international challenges before we get there, and governing is going to be needed. And the biggest implication from this debt ceiling deal is that there's now just a smidge of trust between Kevin McCarthy and Joe Biden, something that did not exist as late as 3 weeks ago.
I wanted to pick up, Dan, on this idea of the tax constraint of how much revenue they can raise, the sort of fiscal drag that starts to take hold. I woke up this morning very excited that maybe we could stop talking about the debt ceiling debate and that perhaps we've moved on. But you point out that once debt servicing costs exceed 14% of GDP, I believe, you end up with this real pressure. Can you talk about what that means economically?
So if you talk to anybody who's been in markets or Washington for 35 years, they're like, deficits really don't matter. There's a lot of complaining about it. But this is the first time our debt servicing cost is rising in 35 years. We measure that by net interest costs as a percent of tax revenue. Interest costs are surging because of higher interest rates, and tax revenues are declining. And so what the debt ceiling really represented, Lisa, was the first course in a larger period of austerity. And how did we reach that conclusion? We went back 80 years, and we looked at whether the U.S. was in a period of austerity or stimulus, and really the defining factors that debt servicing costs. Once you hit over 14%, the bond market starts to put pressure on policymakers, and it forces austerity. I mean, we raised taxes 6 years in a row in the early 80s under Ronald Reagan while we had that 14% interest cost, and it was higher. And so we'll hit it in the next couple of months, and that's why you're seeing Treasury so constrained on its ability to raise debt. I mean, they were raising cash management bills this week at 6.15%. Sure, the debt ceiling added a little premium to that, but come on, at 6% for 3-day cash management bill, it's a pretty big problem. And I think that that's going to be a bigger issue. So Treasury's got to reload TGA, the Treasury General Account. They're going to try and do it out of the reverse repos, Lisa. And that's going to be really hard to do because that reverse repo rate is pretty high. There's no duration risk. And if they can't get it out of reverse repos, it's going to come out of bank reserves, and that means that there's going to be less liquidity. And so we've been arguing throughout the whole debt ceiling debate is that stocks can rally into the debt ceiling debate because there will be massive liquidity being pumped into the system. Once the debt ceiling gets raised, that liquidity may come out, and there poses some risk for financial markets in the second half of the year.
A lot of people focused on the potential for that. Dan, I just want to finish on the election next year. And just a word on the front runners at the moment. Can you think of a time when such a large chunk in the middle of this country is facing the prospect of two candidates facing each other again, that they just don't want them to run?
Great question. I spent 11 weeks on the road into the last election, and every time I'd say Trump versus Biden, no matter who that person was, they gave me a funny look, right? And if Republican, Democrat, old, young, it didn't really matter. And so their support may be a little bit softer than what you would see in the polls because of high name ID. We're going to have a very spirited debate in a Republican primary. I keep an eye on Glenn Youngkin, the governor of Virginia. Seems to be indicating that he wants to get in. Ron DeSantis has won a landslide in Florida. So as he gets used to the rhythm of the campaign, I think he's going to be a formidable candidate. And I keep an eye on Tim Scott. Then on the Democratic side, I would just keep an eye on RFK being a Pat Buchanan-like candidate, what Pat Buchanan did to George Herbert Walker Bush. Joe Biden wants to be the nominee. He will be the nominee. I'm not saying that in any way.
Sure.
But Pat Buchanan dented George Herbert Walker Bush in '92, which ultimately led to Bill Clinton's victory. And there could be some concern about that as we get deeper into the race. So I think we're going to have a very spirited debate. Candidates are going to be tested. And, again, the process isn't very pretty, but I think the outcome will produce one that may be a little bit different than the consensus expects right now.
Interesting. Dan, thanks for that. Dan Clifton there, of Strategas Research Partners. Hear more and more about that. If you don't see that Governor DeSantis bump anytime soon, you start hearing more and more about Governor Youngkin stepping in. TK, is this the best this country can do? I hear that question being asked a lot. Reminds me of 2019 over in the UK, Corbyn, Johnson, same thing. Same conversation. Is this the best this country can do?
Exactly. It's the quality of the people. And one thing I will say is there's an eclectic group, to say the least.
Futures right now, positive. Talk of China stimulus. We'll pick up on that conversation next.